Very good evening, all of you. First of all, please confirm if the audio and video is clear to everyone. Is the audio and video clear to everyone? Wonderful. So since this is a YouTube live class, so there will be 3 seconds time lag. Okay, there will be 3 seconds time lag, 3 to 5 seconds time lag. So please accept that. Okay, now as you know that this will be a 3 days revision session. Okay, wherein we'll be covering the all the relevant standards for the ACCA financial reporting for. Okay, now this is the day 1. Now in the day 1 we'll be covering 3 chapters. The 3 chapters will be non-current tangible assets. As part of non-current tangible assets, we'll be covering property, plant and equipment, that is IAS 16, investment property, that is IAS 40, and borrowing cost, that is IAS 23. Additionally, we'll also do intangible assets, and that is IAS 38, and impairment of asset, that is IAS 36. So these are the 3 chapters which we'll be covering as part of the day 1. Now day 2, that is going to be held tomorrow at the same time. Okay, now, and day 3 I will announce the timing. Okay, initially I thought it to take it on Monday, but it is clashing with my another regular classes. So Monday 5 to 9 we won't take. We will announce the date for the 3rd day of this revision session. Tomorrow I'll announce it off I'll check my schedule and I'll announce it off accordingly. Now, so tell me, shall we start? Shall we start? Now, before I start, a few rules and regulations for the batch. The notes of these classes will be shared after the class, okay, over the WhatsApp group. First point. Second point is you have to take active participation in the class. Okay, see, definitely my revision session is already there on YouTube, okay, which I conducted last year. Now why I'm conducting it again? Only for the point that I want to do it live. Okay, I want to do it live so that you can interact with me accordingly. Okay, now that's the reason I'm conducting it live. So please take optimum use of it and take active participation in the class. Okay, now, and yes, if you are watching this video and you haven't liked the video, so please like it off right now. Please like it off right now. So now, shall we start? Give me thumbs up. On Monday after 9, not possible. Evenings not possible because evening I have my another classes going on from 7 to 10 p.m. Okay, so won't be possible on weekday evening, not possible. So definitely I'll keep it in morning itself. Okay, now all of you, come on guys, do like and subscribe. Yes, 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 do like and subscribe. Now, so let's start. Let's start the topic 1, that is property, plant and equipment. In this classes, in this revision classes, okay, we will be explaining what needs to be done. Okay, what exactly the standard says for that. We'll also discuss which are the areas where you can make a mistake, which you have to avoid. I will also take up some important and relevant questions. Okay, I will also take up some important and relevant questions wherein you can make mistake, but you have to avoid those mistakes. Okay, so I will also cover those things, but yes, I will not be taking up everything in detail as we do in the regular classes, because regular classes is somewhere from the range of 95 to 100 hours, and this will be somewhere in the range of 12 to 15 hours. So definitely we have to cut short on that. Okay, so this is only and only from the exam perspective. Now, so topic 1 is the property, plant and equipment. Property, plant, equipment. So what is the meaning of property, plant and equipment? Tell me firstly. So property, plant and equipment are definitely non-current assets, held for, tell me, use or sale. Held for use or sale? They are held for use. Okay, for what purposes? Use for what purposes? Use for production or supply of goods or services, Now for admin purposes and for rental to others, now when we talk about non-current assets, there are basically let me add a page here, okay, and discuss it off. Okay, I have seen students struggling in this classification a lot. Okay, so now let me discuss non-current assets. Under non-current assets, we classify non-current assets as two types, right? One is tangible non-current assets and another is intangible non-current assets, right? Now what is the meaning of tangible? The one which has physical substance. What is the meaning of intangible? The one which does not have physical substance, right? Now the tangible non-current assets again can be divided into two parts. It is called as property, plant and equipment, and it is called as investment. Property. Okay. Now, what is the definition of in property, plant and equipment? It says they are tangible assets. They are held for use. They are held for use in what? In production or supply of goods or services. For admin works, admin works means you can say corporate offices, admin works, admin purposes, or you can say for rental to others, It can be used for any of the purpose. Okay, now what is the meaning of investment property? Now what is the meaning of investment property? The investment property basically means land, building, or both held for capital appreciation and rental, or you can write and rental to others. Now the query or the frequently asked question is why here also we have rental to others and here also we have rental to others, right? There is rental to others in both, right? Now basically you have to understand the difference. Okay, now when I say that there are tangible assets, if the tangible assets I will divide into two parts now. Okay, one will be called as plant and equipment and another will be called as property, and there is a difference between plant and equipment and property. What is the difference? Plant and equipment might mean this laptop, it might mean a machinery, it might mean a factory, it might mean you can say this mobile phone, this monitor, like this camera. All those things are plant and equipments. Okay, plant and equipments. Property means what? Land, building, or both. Okay, now when you say about the rent, when you say about this plant and equipment, okay, if the plant and equipment is used for production or supply of goods or services, or if it is used for admin purposes, or if it is given on rental, now irrespective of that fact, it will always be called as property, plant and equipment. Now property, if they are held on production or supply of goods or services, okay, or admin purposes, or if they are given on rental. Now if they are this one, then again it is covered under property, plant, but if it is given on rental, it is called as investment property. Now what exactly is the meaning of it? The meaning here is that if you have a property, that you are using for your own purposes, might be production or supply of goods or services, or for admin purposes, or for any other purposes, you are using it. If you have a property which you are using it is property, plant and equipment. But if you have property which you have given on rental to other, that is, or you have held that property for capital appreciation purposes, then we can say that it is an investment property. So now tell me, are you in a position to understand the difference between the PPE and the investment property? Tell me. PPE and the investment property are in a position to understand the difference between them? Is it clear to everyone? Tell me, guys. Okay, wonderful, wonderful. Now, so what I'm trying to say here is the property, plant, equipment is a tangible asset held for use. Life is more than one period, right? Life more than one period means what? It's a non-current asset. It's a non-current asset, okay? Held for production or supply of goods or services, rental to others, or admin works. Okay, now bearer plant, this I will keep it on hold as of now, and I will discuss it when I am discussing the chapter of agriculture. Okay, moving on to the recognition principle. Now, just because if I have an asset and it satisfies the definition of being a property, plant, and equipment, does it mean that I can recognize that in the books of account? I am repeating my question again. Just because I have an asset which satisfies the definition of being a property, plant, and equipment, does it mean that I will be recognizing that in the financial statements? The answer is no. No, it has to satisfy the recognition principle as well. It has to satisfy the recognition principle as well. Now, what is the recognition principle? Probable future economic benefits are expected to flow to the entity, right? Probable future economic benefits means from that asset I will have economic benefits. Now understand, think logically, keeping the standard aside, that why do we purchase an asset? Why do we spend on purchasing an asset? Because we expect that over in the future I will get benefits. I will get continuing benefits over the future. Over its useful life, I will get the benefits. Right? That's the reason why we spend on the asset. So basic recognition principle itself says that from an asset I should get the future economic benefits. And now the cost should be measured reliably. Cost, we are in a position to measure the cost reliably. If these two recognition conditions are satisfied, it is then yes, we can recognize the property, plant, and equipment in the financial statements. Okay. Now, so far we studied what exactly is a property, plant, and equipment. Then we studied if it is a property, plant, and equipment, can we recognize it in the books of account? Can we recognize it in the financial statements? Now we will study that, okay, if it is a property, plant, and equipment, and yes, we can recognize it in the financial statements, then at what amount? We have to recognize? At what amount we have to recognize? Are you understanding, guys? Come on, tell me. Guys, you have to give me booster every 5 minutes, 6 minutes. Okay, why the booster? In the form of yes sir, it is clear. Okay, if it is not clear, you have to ask me your doubt. Okay, now it says that if there is any property, plant, and equipment, in the short form I will say it as PPE. Okay, if any property, plant, and equipment does not satisfy the recognition principle, it cannot be recognized in the financial statements. Rather, the same should be written off as an expense. What is the meaning of it? Let's suppose I purchased an equipment. Okay, I purchased an equipment. Definitely, when I purchased this equipment, I spent money on this. Now, when I spent money on this, but I expect that no, this particular equipment will not give me future economic benefits. Now, in that case, I will say that since the recognition principle is not satisfied, I cannot recognize this asset in my books of account. But I have spent an amount on that. So, what to do about that? What to do for that? So, the standard says that whatever amount you have spent, just write off it to P&L. Write it off to the P&L. Is that clear, everyone? Yes, Gupta. Yes, the juice should be high at every single point of time. Okay. Now, Coming to the third point, that is measurement principle, meaning thereby, if at all we have to recognize this asset in my books of account, if at all I have to recognize this property, plant and equipment in my financial statements, then at what amount shall we recognize this? At what amount shall I recognize this? Okay, this is called as measurement principle. Now measurement principle we have to study at two stages. Okay, that is called as initial measurement and subsequent measurement. What is the meaning of initial measurement and subsequent measurement? Initial measurement basically means that on the date of purchase, when you are actually purchasing the asset, okay, when you are initially recognizing this asset in your financial statements, at what value you will recognize. The second point is subsequent measurement. Now what is the meaning of subsequent measurement? Now subsequent measurement basically means here, the subsequent measurement basically means here that let's suppose I have purchased a laptop. The life of the laptop is 3 years. Okay, I purchased the laptop at a price of $10,000. Okay, so definitely I will recognize this laptop in my books of account at $10,000. Okay, now subsequently over the 3 years, how exactly I will recognize that is called as subsequent measurement. Just to illustrate it with the help of an example, I can say it like this. This is the date of purchase. This is the date of purchase. So the amount at which I have to recognize the property, plant and equipment on this date is called as initial measurement. Subsequently over the useful life, at what value shall I continue to recognize my asset is called as subsequent measurement. Is it clear? Is that clear, everyone? Now subsequently we will have an option. I can measure the asset at cost model or revaluation model, about which we will study subsequently. Okay, first of all we have to study how exactly we will measure the asset initially. Tell me guys, you are not giving me booster. Wonderful. Now meaning of cost. So basically now let's suppose you went to purchase a laptop. Okay, the market price of the laptop was $7,000. But you negotiated with the dealer, you negotiated with the shopkeeper and purchased it for 6,500. Tell me at what price will you recognize the asset in your books? You will recognize at 6,500. What is the market price doesn't matter to me. At what price did I purchase it? What was my cost to purchase the asset is the value at which I will recognize the asset. Okay, what is the market price of the asset? I am not at all bothered about that. Okay, let's suppose Amazon announces big billion days sale, right? Now in the big billion days sale, yeah, so in that the laptop for which the market price was $7,000, you are getting at $6,000 itself, right? So you will recognize that at 6,000, not at 7,000. So what is the market price doesn't matter at all. At what price you were able to purchase is what matters. So initially we will measure the PPE at its cost. Now the question comes up, what is the meaning of cost? The question comes up, what is the meaning of cost? The cost means this. See, the purchase price of the asset, the price at which you purchased the asset. Okay, now plus any non-refundable taxes or import duties. Let's suppose I'm giving you two scenarios here. Okay, let's suppose I am there and Harsh Thakur is there, right? Now both of us purchased a laptop. Okay, but in India I am GST registered, but hers is not GST registered. Okay, now let's suppose when I purchased a laptop for my business purposes, I purchased my laptop for taking classes for you guys. Now I purchased it for, let's suppose, X amount, and I paid 18% GST on that. I paid 18% GST on that. Okay, for me, I will get the input tax credit of the GST, means the GST which I paid, it will be refunded back to me. So for me, the cost is X. But hers, when he acquired the same laptop, he paid X plus 18% of X, right? So for hers, the cost will become 1.18X. For hers, it will become 1.18x. Okay, so we have to see the taxes which we are paying on the purchase of the asset. Is it refundable or not refundable? If it is refundable, it will not form part of the cost. If it is non-refundable, it will form part of the cost. Okay, now further, trade discounts or rebates. Now here you have to be very careful, guys. See here, discounts are of two types: trade discount and cash discount. Trade discount is given to promote sales. Cash discount is given to promote early settlement of the money. So standard says that if there is a cash discount, you are not going to adjust that in the purchase price, in the cost price. Okay, but if you have received a trade discount, you have to adjust that. See, trade discount, yes, you will adjust, but cash discount, no, you will not adjust. Cash discount, or the name can be settlement discount, if any, should not be adjusted with the cost. Rather, the same should be recognized as other income in the statement of profit or loss. Is that clear, guys? Guys, tell me, am I going too fast? You have to tell me, am I going too fast? Do you want me to reduce the speed? Okay. So purchase price plus non-refundable taxes minus trade discounts. Okay, then finance cost under IAS 23. Now what is IAS 23? It is called as borrowing cost. Now it says that if you have incurred any borrowing cost on the purchase, on the construction of any qualifying assets, okay, if you have incurred any borrowing cost or finance cost on the construction of a qualifying asset, okay, then you have to capitalize that as well. Okay, we will study in detail about borrowing cost in IAS 23, which is also our agenda for today itself. Further, it says any directly attributable cost incurred to bring the asset to the location or condition for intended use by the management. What is the meaning of it? It says that if you have incurred, now see, it tried to specify few specific costs, but now it is just giving a generic statement. It is saying that whatever costs you have incurred, I am not specifying transport cost, handling cost, installation cost. I am not specifying that. Rather, the standard is saying, if you have incurred any costs to bring the asset in the location and condition intended by the management, I will capitalize all the cost till that date. Let's suppose I purchased a air conditioner from a local shopkeeper. I purchased a air conditioner, okay, because while taking classes I used to feel the heat was there, okay, due to there are a lot of equipment, so I have to purchase an air conditioner. Let's suppose now when I purchased the air conditioner, the shopkeeper told that, sir, you have to pay the transport cost also. I said, okay, fine, take the transport costs. Now I paid the transport cost on the AC. Now once the air conditioner was delivered to my home, what happened, again the person who delivered, he told that I will not be able to install it off. You have to call the technician, he will install the air conditioner. Now I have to call the technician, he also took the money from me. So now tell me what, the transport cost was to bring the air conditioner in the location where I want to use. The installation cost which I paid was incurred to bring the air conditioner in the condition how I want to use. Just because there is a packet of air conditioner here, I will not feel the cold from there, right? So to make the room cold, I have to install it also, right? So for installation cost also, I have to whatever cost I incur, I have to capitalize that. So the basic intent, what I'm trying to say here is, all the costs incurred to bring the asset in the location and the condition intended by the management has to be capitalized. Krishna has a query, sir. Is any modification cost is a part of the cost like building PP? Okay, Krishna, tell me. Modification cost, when will you incur? When will you incur modification cost? On the date of purchase, will you incur modification costs? On the date of purchase, will you incur modification costs? No, right? It will be subsequent. It will be subsequent. But what I am discussing, initial measurement, right? So hold on for the timing. We'll discuss everything. Now, Mr. Free Classes, sir, could you please cover if lease payments are paid in the mid? Mr. Free Classes, are we discussing leases here? No, right? So please hold on. When in the next class, when we'll discuss leases, everything will be covered. Whatever is in the syllabus, please do not spam the box here, otherwise I have to remove you. Further, so it says any directly attributable cost incurred to bring the asset to the location or condition intended by the management, we have to capitalize that. Okay. Now here this is a very generic statement. Since this is a very generic statement, any directly attributable cost, this is a very generic statement. Now standard gives us the guidance for that. Standard is giving us little bit guidance on that. Now, meaning of directly attributable cost, standard says that directly attributable cost might include these things, might exclude these things. Is it an exhaustive list? No, this is just an illustrative list. They are just the examples. Is it clear? Now, so what does it say? Employee benefit cost arising directly from construction or acquisition of PPE. Now see, understand, employee costs are of two types. Let's suppose I have kept an employee who is helping in the construction of the property, plant and equipment. So I am paying salary for that. Now when I am paying salary to my employee for constructing a property, plant and equipment, this salary will be capitalized as part of the PPE. Now I have purchased a machinery. Now I want to give my employees a training on that machinery. Now when I give training to my employees, this training cost cannot be included. This training cost cannot be capitalized. Why? Now once I give training to my employees, employees are not within my control. They can leave at whenever they want to, right? So they are not in my control. Since I do not control it, and hence I cannot capitalize it. Right? So whatever is a training cost, that has to be expensed to P&L on the date when it is incurred. See, I have written that also. Ideally, I believe I would have written that. Including cost of staff training excludes. See, it excludes, means directly attributable cost exclude this. All these has to be transferred to P&L. All these has to be capitalized to cost of asset. Right? Cost of site preparation, initial delivery and handling cost, installation and assembly cost, professional fees, cost of testing whether the asset is working properly or not, any other directly attributable overheads. See, now overheads are of two types. Directly attributable or allocated. Okay. Now all these guys, all these which I'm saying is my according to my analysis which I've done for the past papers, all the questions of the BPP, Kaplan, right? All the specimen papers, past papers, all this I've done. Accordingly, I'm saying on the basis of my analysis, overheads can be directly attributable. If it is directly attributable, it will be capitalized to cost. If it is allocated overheads, it will be transferred to P&L. Now, cost of conducting business in a new location, including cost of staff training, P&L, cost of introducing a new product or service, P&L, cost of opening a new facility, P&L, administrative or other general allocated overhead, see I have written here, will be transferred to P&L, right? Cost incurred while an item is capable of being operated in a manner intended by the management. Now, let's suppose I have a laptop. It is being operated in a manner I want to conduct it of. Okay, I am able to take my classes regularly. But now what happens? I want to increase. I just want that. I want to take a laptop cover. I want to purchase a cover of it. Okay, or I just purchase a designed keyboards for this. Okay, now what I'm doing? I'm I am definitely doing some expenses. But are these expenses having any future economic benefits? No, they are not having any future economic benefits, right? So standard says that if you are incurring any expenditure on the asset, while it is already in the position of being operated in the manner how management wants to operate it, okay, then you will not capitalize that cost. Any initial operating losses you will not capitalize. But this is a very important point. Proceeds from the sale of the product produced during the testing period. Now let's suppose I had a machinery which used to manufacture biscuits. I had a machinery which used to manufacture biscuits. Now before making that machinery operational for all the employees, what I just wanted to do a test run. So now definitely when I did the test run, the cost of doing the test run will be capitalized to the cost of the asset. But when I did the test run, few biscuits were manufactured. Now tell me, the biscuits which were manufactured, shall I throw it off? No, I will definitely sell it off. Now when I sell, definitely some money will be received, right? The standard says that the proceeds from the sale of any product produced during the testing period, it will be recognized in P and L. Not capitalized to the cost of the asset. Okay, why I am discussing this small point? Because these can come in the question, and these points being very small in nature, you might miss it off, right? We might miss it off. So I want you guys to cover these points. Tell me guys, is it clear everyone till here? Again, you are not giving me booster. I will not remind again and again. You have to continue to give me boosters. Your boosters are the secret of my energy. Wonderful. I'll tell you one fun fact. Once I will complete property, plant and equipment, after that there will be standards like intangible assets, investment property. In standards like investment property, intangible assets, I will just say same as PP. I'll be just saying like that. Okay, so please understand all these points. Okay, Riddhi is saying it means it excluded. Yes, excluded. It means it is excluded. This is not capitalized to the cost of the asset. It means it will be transferred to P and L as other income. Okay. See, I don't know here. Not capitalized to the cost of the asset. Okay. Wonderful. Now, cost of dismantling. Definitely, Mr. Queen kills. Definitely, I'll say here. Cost of dismantling, decommissioning, removal and site restoration costs. Now understand, when I let's suppose I have purchased no Nishan, no surprises. See, I am already giving you the free revisions. This is also a surprise, right? This is also a surprise gift for you guys. Now cost of dismantling, decommissioning, removal and site restoration. Okay, let's suppose I have purchased a big generator set. Okay, or let's suppose I have purchased a very big asset. Now so tell me, when I purchase very big assets, okay, and install it somewhere, or let's suppose I have purchased an oil rig. You know what is an oil rig? Oil rigs are the equipments that extracts oils from the sea bed. Okay, so what you have to do, you have to install oil rig in the ocean, in the sea. Okay, in the sea you have to install it off. Okay, now so when you install these oil rigs, extract the oil from the sea bed. Now when they extract, tell me, and these oil rigs have a life of around 30 to 50 years. Okay, these have a 30 to 50 years. Now what happens here? What happens here is, after 30 to 50 years, tell me, don't you think that area where that oil rig was installed, don't you think it will get deteriorated? Tell me, because you have been continuously extracting oil for the 30 years from that specific location, right? It will get deteriorated. Now the standard says that basically that since that area will be deteriorated, tell me, will the government give you approval to install oil rig? No. The government will say, I will give you the approval to install oil rig if and only if you promise that when you will remove this oil rig from this place, you will restore this area. You will restore this area. Now what happens? Let's suppose the oil rig have a life of 30 years. You installed oil rig here and the life of 30 years. Okay, so now when you will remove this oil rig at the end of 30 years, so the government says that you have to restore this area. You have to restore this area. Okay, you have to promise that, you have made a promise here itself that you will restore this area. The question is, what will be the treatment of this restoration cost? What will be the treatment of this restoration cost? Standard says that tell me, if you do not promise to the government, now can you install this asset? Can you install this asset? No, you cannot install this asset, right? So meaning thereby, without expending this much, we will not be able to install itself, right? So this acts as an enabler asset. Very good, Swam. Very good, Swam. This acts as an enabler asset, and hence what we have to do, we have to capitalize this cost as a part of the cost of the asset. But how? We don't know what will be the incurred. We don't know what will be incurred. So now what you have to do, you have to estimate. You have to estimate that in the future, what is the cost that I will be incurring for restoring. Okay, first estimate, then calculate the present value of it, and then this present value you have to capitalize. This present value you have to capitalize. So what is general entry on capitalizing? Asset account debit to provision for decommissioning, removal or restoration costs. Present value of decommissioning, restoration or removal costs. Okay, now at every year end, what you will do, you will charge finance cost on this provision for DRRC, meaning thereby you will unwind this provision and charge finance cost. You will unwind this provision and charge finance cost, right? Now the asset which we have recognized here. Okay, let's suppose I will give you an example. I purchased the asset at 1000. This provision, this amount is 100. This amount is 100. So my asset becomes how much? 100 is 1100, right? So I will depreciate 1100 over useful life. Okay, now this finance cost means I will unwind 100. I will unwind 100 and record finance costs. I will unwind 100 and record finance costs. I will unwind and record finance costs. Is that clear, everyone? Tell me. Is that clear, everyone? Tell me. Wonderful. Subsequent costs. Now understand what is the meaning of subsequent cost. But first of all, confirm that, guys. Is it clear to everyone till here? Is it clear to everyone till here? Sir, provision for onerous contract mean, Sasank, I will be covering that as part of the provisions standard. Okay, I will take up that also. Okay, don't worry at all. I have come here. If I have come here, I will ensure that I will cover each and every single thing. That is my promise to you guys. But in a proper manner. Unwind means what? Okay, let me take up an example and explain you the meaning of unwinding. Let's suppose the life is 5 years. For the sake of easy calculation, I am taking life is 5 years. Okay, for the sake of easy calculation, I am taking 5 years. Now the cost price is 100. 1000 for the asset. Okay, now you are estimating that here you will incur $300. You will incur $300. Okay, now you will incur $300 here, and the discount rate is at the rate of 10%. The discount rate, yes, Hers, I will be taking up the important questions, not all the questions, but I have identified few important relevant questions which I will be discussing. And in this selection of the important questions, I will be very clear that one of my friend, one of my student also, Mr. Nishan Agarwal, has helped me a lot in this. Okay, so credits to him also. Credits to my friend Nishan Agarwal. Okay, now so this is the cost was $1,000, and the at the year end this is the restoration costs. This is the restoration costs. Okay, now discount rate is 10%. Can you please find the present value of it? Can you please find the present value of it? It comes to 186. It comes to 186. So on this date, what I will do is I will record asset account debit 1186. Okay, to bank 1000, to provision 186. Okay, now what I will do now on every reporting date, now on each reporting date, I will pass two entries. And what are the two entries? One is depreciation account debit to asset. Okay, for year 1, year 2, year 3, year 4, and year 5. Okay, what is the amount? 1186 divided by 5 is 237. 237 and 237. Okay, now I will pass one more entry, and the entry will be finance costs account debit to provision. Now what is the amount of this one? 186 into 0.1 is 19. Okay, 186 into 1.1 is 20.5, 22.5, 24.7, 27.23. Right now, if you calculate, so the asset will get fully depreciated and it will become zero. By the end of 5 years, the asset will become zero, and by the end of 5 years, this provision will become 300. And now, what I will do? I will pay off the provision. Let's suppose I will pay off the provision, and now when I will pay the provision, so what I will do? Provision account debit to bank 300. And this process of recording the finance cost, unwinding the present value, this process is called as unwinding. This provision is called as unwinding. Is it clear now? Those who asked this query of what is the meaning of unwinding, I have explained it to her or him, whatever, whoever it was. Is it clear, guys? So this is how I will unwind. This process is called as unwinding. Okay, the name unwinding is not important. What is important is this process. Is that clear, everyone? Okay, wonderful. Now it might be the case that at the year end 5, you have to pay 290 only, or you have to pay 310 also, right? So whatever the difference, it will go to P&L. It is called a change in the estimates. And whatever is the amount of change in estimates, that will go to P&L. Okay, now I have not covered here because that is not in our syllabus. So this is about cost of dismantling. Is it clear, everyone, till here? Wonderful. Subsequent costs. Now let's suppose I purchased a laptop. Okay. Now I purchased a laptop for $6,500. Now the life of the laptop was 3 years. Okay. Now after using it for 1 year, tell me what happened. My laptop was showing some challenges and I have to get it repaired. I have to get my laptop repaired. Okay. The repair costs me around $400. Tell me this $400, which is my cost, which is my significant cost, not significant, which is my subsequent costs. Tell me, does it satisfy the recognition principle? What is the recognition principle? That the cost can be measured reliably. Yes, we can measure the cost reliably. $400 is the cost. Now it will have future economic benefits. Now tell me, this repair cost, will it increase my future economic benefits? No, it will just maintain the future economic benefits. Right? So that's the reason why we say repairs and maintenance. Why? Because these repairs just maintains the asset. Okay, it does not improve the life of the asset. Okay, now standard is basically trying to say that if you have an asset, which and you are incurring subsequent costs on that, these subsequent costs will be capitalized if it increases the future economic benefits. If it just maintains the economic benefits, it will not be capitalized. If it just maintains the economic benefits, it will not be capitalized. Is it clear, everyone? Right now it says that repairs and maintenance, day-to-day servicing of the asset and minor replacements, expensed off to P&L. Okay. Now when you do about inspections, or we also say it as overhauls, you know what? If there is a flight, Indigo, all the aviation companies basically has to undergo the inspection of the flight every 3rd year or 4th year or 5th year, depending upon the policies. Right? Tell me, are you aware of this point? They have to undergo an inspection. Okay. Without inspection, they cannot be used. Right? And the inspection costs are significant costs. Okay. Inspection costs are very significant, very high. Okay. They are not a small cost. Okay. They are a very significant cost. Now tell me, and it is a government regulation that you cannot, because see, these flights are passenger flights, right? Now it carries the life of around 180 or 200 people at one flight, right? Per flight it carries a life of around 180 or 200 people, right? Now, so definitely government regulations are there, and there are very strict government regulations. Now the government regulations state that you have to undergo inspection every 3rd year or 4th year or 5th year. Okay. Now, so without undergoing an inspection, tell me, can these companies operate the flight? No, right? So it is not option, it is mandatory, right? And it will give me the economic benefits over the next 3 years, and hence these costs will also be capitalized. Okay, so inspections will be capitalized provided it is either an enabler asset or it increases my future economic benefits. Let me give you one more example. How many of you have went to cinema theater or PVR mall or Inox malls? Tell me. I think almost all of you would have visited, right? Tell me. Cinema theaters, right? Or Inox or PVR. Now let's suppose what happens in that PVR. Let's suppose there is a sitting capacity of 100 people. Okay, 100 sitting capacity is there. Now what happened? So in manufacturing this cinema theater, I incurred a cost of, let's suppose, $100,000. I incurred a cost of $100,000. So now what will I do? I will capitalize it. Cinema theater account debit to bank 100,000, capitalized, done. Now the life of the cinema theater is, let's suppose, is 20 years. Now after 5 years, I thought that what happens is the color is of the cinema theater is not looking good. Let's change the color of it. Okay, so I change the color. Okay, and wherever there were you can say defects, I replaced that also. I replaced that and I got it repaired everything. Tell me, the cost which I incur on this one, will I capitalize it? No, I will not capitalize. Now what happened subsequently, after 2-3 years, in the film cinema, I don't know what exactly to say to that. See the screen, in the screen where you see the movie, okay, in the screen something got damaged, okay, a very small part got damaged, okay, again you have to replace that, a very small part, okay, got damaged. Tell me, will you capitalize that? No, it will not be capitalized. Now after 2-3 years, again a very big component of the screen got damaged, okay, the filament got damaged. I don't know whether the filament exists as of now or not, but for example purposes, let's suppose filament is there, okay, filament got damaged. Now the filament which is there, okay, filament or the projector, okay, projector got damaged, okay, fine, it got damaged. When it got damaged, then what happens, in that case I have to replace that. Now will that be capitalized? Yes, it will be capitalized. Now again after 2-3 years, now because the volume, the population of the city has increased, now I want to increase my seating capacity from 100 to 150, right, and I incur a cost of, let's suppose again 80,000. I incur a cost of 80,000 now. Now will this be capitalized? Yes. Why? Because when I increase my seating capacity from 100 to 150, for the additional seating capacity of 50, I will get future economic benefits, right, and the cost I am able to measure reliably, I am assuming that, hence we will capitalize that also. So standard basically is trying to say that whatever is the cost of the inspection or the replacement, I will capitalize to the cost of the asset, provided only if it increases the efficiency or the economic benefits or enables the overall asset to be operated, okay, hence we will capitalize, otherwise we will not capitalize, okay, either it should increase the efficiency or it should increase the economic benefits or it enables the asset to be operated. If any of these three happens, yes, I will capitalize, otherwise I will not capitalize any of the subsequent cost. One of the student was asking me, sir, if I have done any modifications to the asset, will I capitalize? Now the answer is here. If that modification is in the nature of repairs and maintenance, it will not be capitalized. If that modification is in the nature of something which increases efficiency or economic benefits or enables the asset to be operated, yes, you will capitalize that modification. Is that clear, everyone? Accumulated depreciation and accumulated depreciation subsequent to the date of fair value. No worries. Now I am taking, let's suppose you purchase an asset for 1000, okay, the life is 5 years. So what will happen is the depreciation which you will calculate is 1000 by 5 is 200 and 200. Now let's suppose you have to calculate what is the carrying amount here. What you will do, you will say that this is my cost, this is my total depreciation till here. So it will give me my carrying amount as 400. Now let's suppose this is under cost model. If this is under cost model, this happens. Now let's suppose if the asset is under a revaluation model, then what happens? Again you purchase the asset at 1000, the life was again 5 years. Now first year depreciation was 200, second year you charge depreciation of again 200 and the carrying amount was 600, but you did a fair value of 900 here. You tell that the fair value is 900 here, okay. Now the subsequent depreciation will be 300 for year 3, 300 for year 4 and 300 for year 5. Now let's suppose you have to calculate what is the carrying amount at the end of year 4. What will you do? So fair value is 900 and you have to take subsequent depreciation, only these two, you are not required to take these things okay. So just take what is the fair value and what is the depreciation charge subsequent to the fair valuation, that is 900 minus 600 is equals to 300. This is the meaning of it, okay. So this is how you have to calculate the carrying amount of the asset, okay. Now entity shall choose with either the cost model or the revaluation model as its accounting policy, okay. Basically it's a choice that the entity has, whether if it wants to go for the cost model or the revaluation model. It wants to go for the cost model or the revaluation model, okay, and shall apply the policy to all the assets in the same class. It shall apply the policy to all the assets in the same class, okay. Now assets of similar nature of use of property, plant and equipment. What is the meaning of class? What is the meaning of same class? Meaning thereby assets which have assets which are of similar nature and similar use. Example, can laptop and furniture be in same class? No. Can laptop and furniture be in same class? No. Laptop, the nature is different, the furniture, the nature is different, so they are of different class. Okay. Now let's suppose the company has two building. One is called as office building and one is called as factory building. Though the nature is same but the purpose is different. So again they are different class. Okay. So for in one class of assets, in all the office building under one class, all the furnitures under one class, all the office equipments under one class, all you can say factory building under one class, all the plant and machinery under one class. Okay. So we have to see the nature and the purpose. If the nature and the purpose is same, we can group the assets under one class. It's called as classification of the assets. Okay. Now if I am applying the cost model or the revaluation model, I have to apply to the entire class. Okay. So if I am applying the revaluation model to all the buildings in the office building, so all the office building will be under revaluation model. It cannot be the case that one building is under cost model. No, all the building will be under revaluation model itself. Is that clear everyone till here? Now frequency. So when the fair value of the revalued asset differs materially from the basically whenever you think that the carrying amount and the fair value of the asset is differing materially, you can fair value the asset. Generally it is done in once in 3 to 5 years. Generally we do the revaluation. Once in 3 to 5 years. Okay. However, if the fair value experiences significant and the volatile changes, then annual revaluation is also allowed. You can do annual revaluation also in that case. Okay. If the value is changing significantly every year. Now, what will be the treatment of revaluation gain or loss? Revaluation for the first time. If you are doing the revaluation for the first time, the revaluation gain will go to OCI and then to revaluation reserve. The revaluation loss will go to P and L. Now, if you are doing the revaluation subsequently, then what will you do? Okay. Now, so if earlier you had gain and again you have gain, so earlier transferred gain to OCI, again you will transfer the gain to OCI. Earlier you had a gain, but now you are having a loss. So whatever loss you have, you will first of all adjust with OCI, and then if there is any excess loss, you will transfer it to P and L. Now initially you had a loss which you transferred to P and L. Subsequently also you have loss, so you will transfer it to P and L. But let's suppose initially you had loss, but subsequently you have a gain. Now what you will do, to the extent you have transferred the loss to P and L, you will transfer the revaluation gain also to P and L. Any excess revaluation gain you will transfer to revaluation reserve or other comprehensive income. Is that clear everyone? Just have a look at this chart and tell me, is it clear everyone? Is it clear? Chalo. Revaluation approach. How do we do the revaluation? What is the accounting treatment when we revalue the asset? what is the accounting treatment when we revalue the asset? Okay, now the standard says that whenever you revalue the asset, first of all, whatever is the accumulated depreciation, adjust the whole of it against the carrying amount of the asset. Adjust the whole of it against the carrying amount of the asset. Okay, now whatever is the increase or decrease, you record as a revaluation. To take an example of it, let's suppose asset was purchased at 1000, at life was 5 years. Okay, at year end 3. Now what will do? What is the accumulated depreciation? Tell me. At year end 3, what is the accumulated 600, right? So what you will do? And now the fair value here is 900. So what is the accounting entry? What is the accounting entry for it? So first of all, what you will do? Accumulated depreciation account debit to asset. So basically, I am reducing the gross block of the asset by 600 by 600. Now, what is the assets gross block? Tell me, what is the assets gross block? It becomes 100 minus 1000 minus 600 is equals to 400. Now, tell me, what is the fair value? 900, right? So what I will do? I will increase the asset. Now, asset account debit to revaluation reserve, that is other comprehensive income. How much? 500. This is how I will do the accounting treatment. Is it clear, everyone? Tell me. See, this is what is the journal entry that I passed here also. First of all, 600 is the adjustment of accumulated depreciation with the asset, and asset account debit to revaluation reserve is how much? 500. Is how much? 500. Now, is it clear, everyone? Is it clear, everyone? Tell me. Wonderful. Treatment of revaluation reserve. Now, whatever is the revaluation gain or loss which you transfer to a revaluation reserve, what is the treatment of it? So the standard says that there are two treatments, that there can be two optional treatments. The treatment number one, whatever is the balance of revaluation reserve which you can, whatever is the balance in revaluation reserve, you can transfer all of it to retained earnings when you derecognize the asset. Okay, transfer the whole of it to retained earnings on derecognition or disposal of the asset, or you transfer the amount of revaluation reserve to retained earnings over the life of the asset. Now let's suppose here in the same question, tell me what is my revaluation reserve? Tell me. 500. My revaluation reserve is 500, right? What is the remaining life? 2 years. 2 years. I am taking up 3 cases and will discuss. Case number one. My policy is to transfer the revaluation reserve to retained earnings on derecognition. Okay, so now tell me, when will I derecognize? Here. So I will transfer this RR to retained earnings on this date. First point. This is case 1. Okay. Case number 2. The policy of the company is to transfer the revaluation reserve to retained earnings over the life of the asset. So what I will do in that case, I will transfer 450 here. I will transfer 450 here. Is that clear, everyone? Tell me. Is that clear, everyone? Tell me. Case number 3. My policy is again to transfer the revaluation reserve to retained earnings over the remaining useful life of the asset. So what happened? I definitely I will transfer. But what happens on this date and in the mid of the year, or not in the mid of the year, here I sold the asset. So if my policy is to transfer the revaluation reserve to retained earnings over the remaining useful life of the asset. Now definitely this year I transferred 450, right? But here I sold the asset. So when I am selling the asset, when I am derecognizing the asset, standard says that whatever is the balance then, whatever is the balance. Okay, 250, sorry, my bad. 250. Whatever is the balance, okay, you will transfer to revaluation retained earnings. So 250 I transfer to retained earnings here. Is that clear? The 3 scenarios are clear. Tell me, is the 3 scenarios clear to all of you? Yes, it's 250. The amount which I entered was wrong. Okay, sorry for that. It's 250. I'm sorry for that. Is it clear, everyone? So I have taken up three situations which I believe I have explained it off. Now coming back to the notes. Even if an entity opts for option number 2, even if, see this I'm talking about case 3, even if an entity opts for option number 2, then if on disposal of the asset there is a credit balance in the revaluation reserve, then that should be transferred to retained earnings. Okay, if on disposal of the asset, if there is any credit balance sitting in the revaluation reserve, transfer it to retained earnings. Basically what is it trying to say, that once the asset is derecognized, there should not be any revaluation reserve pertaining to that asset. There should not be any revaluation reserve pertaining to that asset. Whatever is the revaluation reserve pertaining to the asset, I will have to transfer it to retained earnings at the very moment when I derecognize the asset. Is it clear, everyone? Tell me, is it clear, everyone? Now this note is very important. If an entity opts for option number 2, special care needs to be taken while adjusting the revaluation loss or impairment loss with revaluation reserve, considering a portion of the reserve is already transferred to retained earnings. Guys, trust me that this is a very, 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 very important point. The ones which I've highlighted in brown are the areas where the student makes mistakes. Okay, so I want you to take special care of this. Okay, let me discuss what exactly I'm trying to explain. Asset had a life of 10 years. I purchased for 1000. Now at year end 3, tell me what will be the carrying amount? 700. The fair value of the asset. The fair value of the asset is, let's suppose, just give me a minute. Is 910. Okay, so what is the revaluation reserve? 210. Right, now let's suppose again at year end 5. Tell me what is the carrying amount of the asset? Tell me what is the carrying amount of the asset? 210 divided by 7 into 5 is 150. I am asking carrying amount of the asset is 150. Tell me yes or no. Now right here, the company has a policy to transfer. The company has a policy to transfer RR to RE every year over remaining useful life. Okay, now carrying amount is 150, right? Now the fair value, how much is the fair value? So let me not 150, it is 910 divided by 7 to 5 is 650. 650, right? Tell me yes or no. Carrying amount is 650. Tell me yes or no. $910 was there, remaining life was 7 years, right? Depreciated for 2 years, so depreciation is 260, right? So 910 minus 260 is 650, right guys? Okay, now the fair value. Okay, now tell me what is the just a minute. 200. Now your fair value is, let's suppose, 450. Now you have a revaluation loss of how much? 200. My question is, how will you treat this revaluation loss of 200? My question is, how will you treat this revaluation loss of 200? Now a student will say, sir, I had a revaluation reserve of 210, my revaluation loss is 200, so I will pass entry as revaluation reserve account debit to asset. I will adjust this revaluation loss with this revaluation gain. But dear friend, my dear friend, if you do this one, you will get 0 marks, a big zero, like say a big zero, you will get a big zero. Now you have to find that, you have to understand that you would have transferred a portion of revaluation reserve to RE. You will get a portion of revaluation reserve to RE, right? And now what is the balance of RE? What is the balance of revaluation reserve here? It is only 150. It is only 150. How come? So 210 divided by 7 into 5 is 150. Is 150. So what we will do? Revaluation reserve account debit, definitely yes. By how much? 150. By how much? 150. Then I will write P and L account debit, how much? 50. To asset is how much? 200. See, this is how I have to do it off. I believe it is clear to everyone. Moving back to the notes. Self-constructed asset. If I have, rather than purchasing the asset, I have constructed the asset. I have got the asset developed. So standard says that same measurement principle as discussed above. However, the cost of abnormal amounts of wasted material, labor or other resources incurred in self-constructing an asset is not included in the cost of the asset. It says that when you are doing the self-construction, if you are doing the self-construction, then in that case, if you are doing the self-construction, then in that case, what you have to do here is the amount which is abnormal waste, which is an abnormal waste, that will not be capitalized. All other cost, all other measurement principle will be the same. Just the abnormal waste of material, labor or whatever it is, it will not be capitalized. Now depreciation. So depreciation is what? Is a systematic allocation of the depreciable amount over the useful life of the asset, right? Now how to calculate depreciation? How to calculate depreciation? Tell me. How to calculate depreciation? The original cost divided by the full useful life, or if the asset is a revalued asset, if the asset is a revalued asset. Abnormal waste. What is the meaning of abnormal waste? Okay, we know that, let's suppose I have to construct a machinery, I have to or a building. I want to construct a building for my own purposes. Okay, now for the office purposes. Now what happened in that case? I know that in the construction of this building, I will need 100 tons of cement. Okay, I will need 100 tons of cement. I will need 100 tons of cement. Okay, and considering why 100 tons, so I know that 95 tons I will use. 5 tons definitely it will get wasted in the transport. It will get wasted in the transport. It will get wasted in the transport. Okay, but now what happens? What happened was the cement was kept in outside. The cement was kept outside the premises. Okay, and one day what happened? It rained, and all 50 tons of cement got wasted. 50 tons of cement got wasted. Okay, now tell me, is that a normal waste? No. It is an abnormal waste. It is an abnormal waste. What is the meaning of abnormal waste and normal waste? Normal waste is something which cannot be avoided. It will happen only, right? When you will transport the cement will be wasted in the transit. Abnormal waste is a waste which can be avoided. Okay, now coming back to the depreciation. So it says that if the asset is fair valued, if the asset is under revaluation model, so you have to take the fair value of the asset, divided by the remaining useful life to calculate the depreciation. Now one more thing, methods of depreciation, residual value, useful life are all estimates. They are all estimates. Estimates means they are supposed to change. They might change in the future. Okay, and has to be reviewed at each reporting date. Any changes in such estimates has to be accounted for prospectively in P and L. Okay, any changes that happens, we will account for it prospectively. No retrospective accounting. Okay, now, so what is the meaning of depreciable amount? It means the cost of the asset minus the residual value of the asset. Okay, fine. Now depreciation ceases when the other asset is sold or classified as held for sale. You remember IFRS 5? Right? Under IFRS 5 we discussed whenever as and when we classify an asset as held for sale, depreciation ceases. Right? So standard is saying that once the asset is sold or is classified as held for sale, you will cease the depreciation. Okay, depreciation should be recognized in P&L unless it can be capitalized to the cost of any other asset. Is that clear, everyone? Tell me. Now, component accounting. What is the meaning of component accounting? It says that if there are assets, let's suppose I have purchased a flight. Okay. The life of the flight is, let's suppose, 20 years, and there is an engine in the flight, and the engine of the flight has, let's suppose, a life of 10 years. Okay, and the engine is a significant part. Of the asset. So standard says that in that case, I will depreciate engine separately from the entire asset. So it says that each part of an item of PPE which is a cost that is significant, the engine has a cost that is significant in relation to the total cost of the item and having a different useful life, should be depreciated separately. Okay. Now, as I told the example, the engine is a very significant part of the aircraft. Now, aircraft has a life of 20 years and the engine has a life of 10 years. So, in that case, I will depreciate engine separately and the rest of the aircraft separately. Component accounting can be followed even if the cost is not significant. Standard says that if you want to follow component accounting, even if the cost is not significant, you can follow that. This is optional. If you want, you can follow that. That's why it can be followed. I have written. Okay. Now, derecognition, the PPE should be derecognized either on the disposal of the asset or when there are no future economic benefits are expected from its use or disposal. If there are no future economic benefits which we are expecting from its use or from its disposal, then I will derecognize the asset. Okay, I will derecognize the asset. Any gains or losses arising on the derecognition of the PPE is recognized in the P and L. Is it clear, everyone? Tell me. Now, cost which can be capitalized. See, this what I have done is I have made up I have tried to make up an exhaustive list based on my analysis of the past papers. Okay, all the papers I have analyzed, and whatever cost can come in the exam. So far, whatever has come in the exam, I have tried to list everything. See, I have tried to list everything. So far, whatever has come in the exam or it can come in the exam, I have tried to list everything. Just let's see. List price of the machine, I will capitalize. Trade discount, I will reduce from the cost of the asset. Cash or settlement discount, I will transfer to P&L. Non-refundable taxes, I will add to the cost. Refundable taxes, I will reduce from the cost of the asset. Import duties, I will add to the cost. Delivery handling charges, I will add. Installation fees, I will add. Product costing or cost of testing, I will transfer to P&L. Proceeds from the sale of product, I will transfer to P&L. 5-year maintenance contract I have purchased. Okay, I will transfer it to P&L. Site preparation cost, P&L. Professional fees on acquisition advice, P&L. Interest charge on qualifying asset, I will add to the cost of the asset. Okay, professional fees I will add to the cost of the asset. Investment income on the temporary funds. Okay, investment income on the temporary funds. We will study in borrowing cost chapter IS 23. Okay, investment income on temporary funds during the period of capitalization, I will reduce from the cost of the asset. Stamp duty and legal fees I will add to the cost of the asset. Architect fees I will add. Material, labor, leveling of the land I will add. Employment cost for construction I will add. Employment cost for training I will transfer to P&L. Directly attributable overhead cost, I will add to the cost. Allocated I will transfer to P&L. Cost of relocating employees, P&L. Opening ceremony, P&L. Income received on temporary use, P&L. Cost of purchase of land, add to the cost. Income from use of car parking, P&L. Or provision for decommissioning, removal and restoration, add to the cost of the asset. Okay, now these are the tips that you have received from the examining team. How I got these tips? I have reviewed the examiner reports. I have and I have reviewed your study materials from the BPP kit, Kaplan kit, all thing, and I have noted the tips from the examining team. So examining team is saying that the diminishing balance and reducing balance is the same. Don't think they are different. They are same. Okay, diminishing balance, reducing balance, or the another name is WDV method, written down value method. All are same. The names same and the names can be used interchangeably. Standard is again trying to say, okay, the examiner is trying to say, not the standard. Sorry, my bad. The examiner is trying to say date of revaluation should be noted carefully. Standard, the examiner is saying, dear student, please note the date of revaluation carefully. Why? As it will impact the subsequent depreciation. Are you understanding it? Now, examiner is again saying revaluation reserve is transferred to retained earnings over the life of the asset only if specifically mentioned in the question. If the question is silent, you will transfer revaluation reserve to retained earnings at the time of disposal of the asset. Is that clear? Is that clear? Now, okay, if the question is silent, then transfer revaluation reserve to retained earnings at the time of derecognition of the asset. On disposal of the revalued asset, now the examiner is saying that these are the areas where they have noticed that the student makes mistakes. These are the areas where the examiner has noticed that the student makes mistakes. Okay, so you are not required to repeat these mistakes in the exam, guys. Okay. Now, bank account debit. On disposal of revalued asset, what will you do? You will record bank account debit to asset to P&L. This is the entry. Now, how bank sale proceeds on asset? I will take carrying amount on date of sale. Now, what is the meaning of carrying amount on date of sale? Meaning thereby fair value of the asset minus subsequent accumulated depreciation. Okay, P&L is the balancing figure. Now, whatever is the balance in the revaluation reserve, I will transfer it to retained earnings. Okay. PPE acquired in business combination is recognized at fair value on the date of acquisition. Is it clear, everyone? Tell me. Is it clear, everyone? Tell me, guys. Come on. Come on, guys. Wonderful. Wonderful. This completes our standard on property, plant and equipment. And from now onwards, all the standards will be small. Okay. Property, plant and equipment, we have to devote a significant time. Why? Because we have to cover everything. Okay. Now, in the rest of the topics, you will see that everything I'll say that it is covered under PPE, covered under PPE. Okay. I will discuss only the relevant points, not all the points. Is it clear, everyone? Anyone having any queries? Yes, it will be cakewalk now. So see, investment property, I have already discussed the meaning of it. Okay, now what? It is a property, meaning thereby land or building or both, held for what? Rental to others or for capital appreciation. It is not held for production or supply of goods or services, for admin purposes or sale in the ordinary course of business. Because if it is held for these purpose, it is called as property, plant and equipment. If it is held for sale in the ordinary course of business, it is called as inventory. It is called as inventory. If it is held for sale, it is covered under IFRS 5. Are you understanding this? Are you understanding the scope? Tell me, guys, are you understanding the scope? If you have investment property, if you have a property, land, building or both used in the production or supply of goods or services, it is called a PPE. Okay, in admin purposes, it is called as PPE. If you have held it for sale in the ordinary course of business, it is called as inventory, and if you have held it for sale, it is called as IFRS 5. Let me give you an example of it. Reliance has a land or building or both which it uses for office purposes. Is called as PPE. Reliance has a land, building or both which it has leased out. It will be called as leased out, means given on rental. It is called as tell me, it is called as what? It is called as what? Investment property. Now come back to this one. Now what, just to give you the good understanding, a good grip on the classification, let us solve this. Okay, firstly, property, if it is held for use, okay, it is called as property, plant and equipment. If it is held for sale in the ordinary course, it is called as inventory. Okay, property, if it is held for sale, it is called as under IFRS 5. Property, if it is held for rental to employees, if it is held for rental to employees, property, plant and equipment. Held for capital appreciation, tell me what? Come on guys, tell me. I'm waiting for your answers now. All of you have to complete this. All you have to complete this. I'm waiting for your answer now. Held for capital appreciation or rental. See, OL means what? OL means what? I'm writing here. OL means operating lease. Okay, now it is called as investment property. It is called as investment property. Vacant property, if it is held for use, then it is again called as property, plant and equipment. If it is held for sale in ordinary course of business, it is called as inventory. Held for capital appreciation or rental, it is called as what? Investment property. Purpose is undetermined. If there is a vacant property, and the purpose is undetermined, then we say it as investment property. Okay, it is also called as investment property. Now, under construction property, held for use, property, plant and equipment. Held for sale in ordinary course of business, it is called as inventory. Held for capital appreciation, it is called as investment property. Undetermined purpose, investment property. Now, why everywhere I have mentioned operating lease? Okay, now understand that when you will go to SBR level, I will teach you that in the books of lesser, the lesser has to assess whether this is an operating lease or a finance lease. When it is a finance lease, they have to de-recognize the asset itself. Okay, so that's what I am writing here also. If a property is given on finance lease, the property will be de-recognized and hence no need of classification. At FR level, I will say that this understanding is not required. So let's cut it off. Let's cut off this part also. Let's cut off this part also. Let's cut off this part also. Okay, at FR level, this operating lease and finance lease classification understanding is not required. So let's cut it off. Is it clear? The classification is clear. Tell me. Now, do you think you are in a position to better classify the investment property and the property, plant and equipment? Vacant property, undetermined purpose. Vacant property, undetermined purpose should be IP. It should not be PP. Tell me, no. You have a flat. Okay, it is vacant and you don't know what is the purpose of it. So why have you purchased it? Why did you purchase the flat? You purchase the flat for investment purposes. You don't know what to do means you have purchased for investment purposes. Okay. Now, recognition principle is same as recognition principle of PPE. See, probable future economic benefits are expected to flow to the entity and cost can be measured reliably. Now, measurement principle, initial cost, initially you have to measure it at cost. The meaning of cost is same as PPE. Subsequent cost, the treatment is same as PPE. Subsequent measurement cost model is same as PPE. Okay, I will write here. This is same as property, plant and equipment. This is same as property, plant and equipment. But this is different. We will study this. Tell me, do you want me to explain it again? The same thing again? Do you want me to explain the same thing again? No, I will not be explaining, right? I will not be explaining. Let's not strike it off. There is a query coming. Undetermined purpose should be PPE. Let me tell you. Vaisali, listen and think logically. Vaisali, you have purchased a flat. You don't know what to do with that flat. Then why did you purchase? Tell me, Vaisali, you purchased a flat, but you don't know what to do with that flat. Tell me, then why did you purchase the flat? For investment. That's why it says that when the purpose is undetermined, you have to say it as an investment property. Clear, Vaishali? Clear? Now, so this is already explained. I am not explaining it again. Initial measurement, subsequent measurement also I am not explaining. It is already discussed. Depreciation under cost model is also same. I am not explaining. Now I have to discuss with you the revaluation model of this. Understand? The revaluation model of PPE and the revaluation model of investment property. If not vacant, tell me where is the query, Vaishali? Capital appreciation or rental, it is IP. Okay, see, if it is, understand, any property held for use PPE, held for use PPE, held for sale inventory, held for sale in the ordinary course inventory, held for sale under IFRS 5, held for sale under IFRS 5, held for sale under IFRS 5, then capital appreciation, held for capital appreciation, held for capital appreciation or rental to others, investment property. Purpose is undetermined, it can be any purpose. Okay, then it is investment property again. Okay, PP under revaluation model. Tell me what is the frequency? What is the frequency? The frequency is generally once in 3 to 5 years. Now you can apply on a class by class of PPE basis. You can apply on a class of PPE basis. Okay. Now further, when you do the revaluation, the revaluation gain or loss goes to other comprehensive income, that is revaluation reserve. Right? Right? Tell me, then depreciation is equals to fair value of the asset divided by remaining useful life. Now, under revaluation model of investment property, you have to do the revaluation every year. Class, it says you have to, if you are opting for revaluation model, it should be for all investment property, meaning thereby it says that investment property is one class. There is no further class under investment property. What the standard is trying to say is there is no further class under investment property. There are questions in your practice kit and revision kit. It will say that if the investment property has to be revalued, we will apply to all the assets in the same class of investment property. No, that is wrong. All investment property are one class, but under PPE there can be multiple class. Okay, so if under PPE I am opting for revaluation model, I will opt for any specific class. Okay, now but if I am under revaluation model under investment property, then I will apply the revaluation model for all investment properties. Either all the investment property will be under cost model or all the investment properties will be under revaluation model. Now when you will take the revaluation gain or loss, it will go to P and L. It will go to P and L. Now the depreciation stops. Depreciation is not there. Depreciation is not there. Why depreciation is not there? Because we are doing the revaluation every year. Because we are doing the revaluation every year. So whatever is the impact on account of wear and tear of the asset, it gets accounted for by way of fair value of the asset. Is it clear, everyone? Tell me. It gets accounted for by way of fair value of the asset. So this is the fair value model of investment property. Is it clear, everyone? Tell me, guys. Come on. This is an important part of the fair value model of investment property. This is the important part of the investment property. Okay. So it says that fair value of the asset, fair value gain or loss will go to P&L. Depreciation ceases if investment property is at revaluation model. It will give you the net carrying amount of this one. Now all the an entity shall choose either cost model or revaluation model as its accounting policy and shall apply that policy to all investment properties. To all investment properties. This is a very important term. To all investment properties. Is it clear, everyone? Wonderful. Now, transfers to or from investment property. This part I have to discuss with you. See, understand. Property, there is a property, there is a building. There is a building which I was using for my own corporate office, But what happened? I don't. What I want to do is I want to move to new office, and this office I don't want to use. So what I did is So if it is corporate office, it will be classified as property, plant and equipment. But now I want to move to a different property, and this property I want to lease. I want to give it on rental. I want to give it on rental to others. Now it will become investment property. Or it can be the case the property was given on rental, hence it was investment property. Now I want to use it for my office work. I want to give it for my office work. It will become property, plant and equipment, right? So standard says that it can be the case that the property can be classified from investment property to property, plant and equipment, or property, plant and equipment to investment property, or investment property to inventory, or inventory to investment property. Okay, these classifications can so happen. Okay, now the standard is saying that there can be 8 possible cases. Investment property to PPE. See, the first 4 cases is investment property to PPE. The next 4 cases is property, plant and equipment to investment property. How exactly will we treat this? Okay, let me explain that. So standard says that if this is the date of reclassification, so standard says that till this date, you will follow old classification. Now, subsequent to this date, subsequently, you will follow new classification. Now, there are 8 cases. Let me discuss few cases. So earlier it was PPE. Now it is investment property. PPE it was at cost, and investment property is at cost. It is also at cost. Tell me, is the cost model of PPE and IP same or different? Cost model of PP and IP same or different? It is same. So what will happen? So the comment here is measurement will remain the same. Just the name will change. Now, second case. PPE is at cost to IP is at fair value. Okay, IP is at fair value. Now, IP is at fair value means on the date of reclassification, what happens? It says that we have to transfer to IP at its fair value. Okay, so now it will be at its cost price, it will be at its carrying amount, right? And there will be fair value. Okay, so standard says that recognize investment property at its fair value on date of reclassification, and then the standard also says that the difference between carrying amount and fair value on date of reclassification. Tell me where will it go? Let me see who can answer it correctly. You have exams after 7-8 days, around how many days? 26, 27, 28, 29, 30, 31, 5 days and 6 days, 11, 10 days, around 10 days you have. Tell me, where will this difference go? Let me see who can answer it correctly. In this case, tell me where will PP is at cost and IP is at fair value. Where will this difference between carrying amount and fair value go? So Hiral is saying P&L, Queen is saying P&L, and Vaishali, Arun, Vaishali, Hers, Muzna, Kidwai, Pooja, everyone is saying revaluation reserve. So let me tell you, it will be revaluation reserve. Why? I told no that this fair value gain or loss is pertaining to this period, right? So for this period, what was the classification? PPE. And under PPE, how do we treat the revaluation gain or loss? It will be transferred to revaluation reserve. It will transfer to revaluation reserve, right? Now, next example. Next example. PPE is at fair value and IP is at cost. IP is at fair value. So here will be fair value. So standard says that this fair value will become the cost of investment property. This fair value will become the cost of investment property. Nothing else. This fair value will become the cost of the investment property. Any fair value gain or loss till date will be transferred to revaluation reserve. Any fair value gain or loss from here will be transferred to P&L. Clear, everyone? Sorry, no, there will be no fair value gain or loss, right? There will be no fair value gain or loss because the IP is at cost model. Because the IP is at cost model. Is it clear, everyone? Now, next case. PPE is at fair value and investment property is also at fair value, right? Now, the fair value of PPE here will become the fair value of investment property, but here the any revaluation gain or loss here will be transferred to revaluation reserve, but any revaluation gain or loss here will be transferred to P and L. Is it clear, everyone? Tell me, guys, is it clear, everyone, till here? Then only I'll move ahead. Is it clear, everyone, till here? Wonderful. Further. Investment property PPE. Investment property is at cost and PPE is also at cost. So any no, there is no change in the measurement. There is no change in the measurement. There is no change in the measurement. But only the name changes. Queen in the PP in IP we don't depreciate if it is under revaluation model. Okay, we will depreciate if it is under cost model because the cost model of investment property is exactly the same as the cost model of property, plant and equipment. Okay, but under fair value model of investment property, we do the fair valuation exercise every year, and hence we do not depreciate the investment property if it is under fair value model. Now, okay, if the IP is transferring to PPE and both are under cost, so there is no change in the measurement, there is no change in the amounts, only the name will change. If IP is at cost but PPE is at fair value, then what will we do? Here it will be at cost itself, but I will recognize the PPE at its fair value, right? So now tell me, recognize PPE at fair value on date of reclassification. But in difference between carrying amount and fair value, tell me where will it go? This difference, where will it go? Come on, guys, tell me where will this difference go? Revaluation reserve, right? This difference will be transferred to revaluation reserve, right? P and L, very good. P and L. P and L. All of you answered correctly. Wonderful, wonderful, wonderful. Then next point, IP is at fair value and PPE is at cost. PP is at cost. So now what we do, the fair value in the date of reclassification will become the cost of the PPE. Here any revaluation gain or loss here will be transferred to P and L. Any revaluation gain or loss here will be transferred to P and L, and here there will be no revaluation gain or loss. No revaluation gain or loss. Now the last case. IP is at fair value and PPE is also at fair value. So now what will happen? The fair value of the PPE will become the fair value of the investment property will become the fair value of the property, plant and equipment on the date of reclassification. But any revaluation gain or loss here will be transferred to P&L, and any revaluation gain or loss here will be transferred to revaluation reserve. Is that clear, everyone? Is that clear, everyone? Come on, guys, tell me, is that clear, everyone? Wonderful. Coming to the notes again. So this also I have discussed. This also I have discussed with you guys. Derecognition, again similarly says investment property should be derecognized when on its disposal, or if the IP is permanently withdrawn from use, not withdrawn from use, I can say, sorry, that is wrong. Withdrawn from is when IP does not have any future economic benefits. Okay, there are no future economic benefits, then I can derecognize it off. Okay, gains or loss arising on derecognition of IP is recognized in P and L. Is it clear, everyone? Disclosure, understand, the entity should following the cost model for investment property must disclose its fair value in the notes to accounts. Okay, if you are opting the cost model, then entities should disclose that what exactly is the fair value of this investment property in the notes to accounts. You have to give it as a disclosure. Okay, now the tips from the examining team: deal with the transfer cases carefully as part of the adjustment in section C questions on preparation of financial statement single entity. So deal with this. Basically the examiner is saying that deal with the transfer case. Come on guys, tell me. Waiting for your responses. Wonderful. Okay, investment property acquired in business combination is recognized at fair value on the date of acquisition. Okay, so basically it's not about investment property or property, plant, equipment. The standard IFRS 3, we will study that in the group accounts, that all assets acquired under business combination, is recognized at its fair value on the date of acquisition. Do you know this? You would have studied this in the case of group accounts chapter. Is it clear, everyone? Now this completes our discussion on investment property. Also moving on to the new standard, that is borrowing costs. But before I go to borrowing cost, I have a query coming up from others. Sir, revaluation reserve, when it will transfer to retained earnings? Understand others, three situations. Revaluation reserve, if you have a revaluation reserve, you have two options. Option number one, this, first of all, understand that this will be always be transferred to retained earnings, but when is on recognition of asset, on derecognition of asset. Okay, or over remaining useful life of asset, But now write one more point here. However, if the asset is disposed, okay, before end of its useful life, then any credit balance in revaluation reserve will be transferred to retained earnings on the date of that disposal. Is it clear now, others? This is what IAS 16 says. This is what IAS 16 mentions. Is it clear to you, others? Waiting for your responses. Okay, fine. I'll move ahead. So now the next chapter which we have to study is borrowing costs. You guys want a break? Okay, so let's take a break of 10 minutes and then we'll resume back. The class will run till mostly, I think it will be till 8:30, or if not then by 9. Okay, because I have to cover up 3 more topics, though it won't take much time. 3 more topics, though it won't take much time. After these 3 topics, I have to discuss 5 questions with you. I have to discuss 5 important questions with you. Okay, there are 5 questions which I have identified for you guys that I will discuss with you. Okay, so by mostly by 9 we will get over. Okay, earlier only, but I'll try to wrap up by 9. Okay, 10. Let's take a break of 10 minutes. Okay. So let's assume, guys. Let's assume. Audio, video clear? Can you please confirm? Audio and video clear, everyone? Okay. Wonderful. Wonderful. So let's start with the topic number 3, that is borrowing costs. So, so first of all, understand the standard says that the borrowing costs incurred that is directly attributable to the acquisition, construction or production of a qualifying asset is capitalized to the cost of the asset. All others are expensed off to P&L. Now let's suppose you purchased an asset. I am discussing multiple situations with you, okay, to explain it to you. Now situation is, you purchased an asset by taking a loan. So the borrowing cost incurred, will it be capitalized? No, it will be transferred to P&L. You took a loan and you constructed the asset. The borrowing cost incurred on the construction of the qualifying asset, will that be capitalized? Yes, it will be capitalized. Now you purchased an asset and then constructed another asset on that asset. Let's suppose you purchased a land, okay, just for the sake of purchase of land. So the borrowing cost incurred on the purchase of land, will that be capitalized? No. You purchased a land and you took a loan and then you constructed a building on that. Right? So the borrowing cost incurred on the purchase of land will also be capitalized. Okay, so that's the reason why it is writing here the word acquisition. Why here writing the word acquisition? Construction is for the assets, production is for the inventory. Okay, now, so meaning of borrowing cost, it means all the interest and other costs that an entity incurs in connection with the borrowing of funds is called as borrowing cost, but it excludes cost of equity, including preferred capital not classified as liability. Okay, so meaning thereby, if you have incurred the cost for a loan, for a financial liability, for a loan, for borrowings, that borrowing cost I am discussing here. I am not discussing about the dividend expense. I am discussing about the interest expense. I am discussing about the finance costs. Okay. Now, construction of this flat will take substantial period of time, right? So in that case, this inventory can also be classified as qualifying asset. It's not the case that only property, plant and equipment or investment property can be classified as in qualifying asset. No, any asset, whether it be property, plant and equipment or investment property or intangible assets or inventory or any other assets, if it takes substantial period of time to develop and we have incurred the borrowing cost on that, then we can capitalize the borrowing cost incurred to the cost of the asset during the period of capitalization. So I have mentioned few important terms here. I can capitalize the borrowing cost incurred, meaning thereby if you have incurred the borrowing cost, then only you can capitalize the borrowing cost. You cannot say, let's suppose I constructed a building from my own funds. So I cannot say that if I would have taken a loan, I would have incurred the borrowing cost. So hence I will capitalize the borrowing cost. No. Or I cannot say like this, that since I have used my own money, so if this money, rather than using it in the construction of this building, I have invested it somewhere else, I would have got interest there. But since I am using it for the construction of my building, I have foregone that interest. So that interest is also a cost for me. That is an opportunity cost for me. No, I'm not talking about opportunity cost, notional cost. I'm not talking about that. I am talking about if you have incurred the borrowing cost. Actually, if you have incurred the borrowing cost, yes, you can capitalize that. If you have not incurred the borrowing cost, no, you cannot capitalize that. Okay, point number 1. Second point, you can capitalize the borrowing cost only for the period of capitalization. Okay. Any period before the period of capitalization or any period after the period of capitalization, you cannot capitalize the borrowing cost. Sir, then what is the meaning of period of capitalization? I will discuss here. See, I will discuss here. I will discuss the period of capitalization with you. Okay. Now further. Okay. Qualifying assets, the asset on which I am incurring the borrowing cost. should be a qualifying asset, meaning thereby it has to take substantial period of time to develop. Now understand, the capitalization of borrowing cost has three important points that you need to remember. What? Three important points that you need to remember. I am writing it off here. The asset should be a qualifying asset. Okay, the asset should be a qualifying asset. The borrowing costs should be actually incurred. Notional borrowing cost I am not talking about. Third, I will be capitalizing only the borrowing cost incurred during the period of capitalization. Any borrowing cost incurred prior to this period or after this period will not be capitalized. Okay, now what is the meaning of qualifying asset? Standard says that it is not defined. Substantial period is not defined. Okay, till okay, it says that IAS 23 does not provide any guidance on what constitutes a substantial period of time. However, it is likely that a period of 12 months or more might be considered substantial. But now in the exam, let's suppose a question comes up where it says that the period of construction is 6 months. It takes 6 months for the construction period. So will you leave the question stating no, this question is not this asset is not a qualifying asset, so I will not capitalize the borrowing cost? No. Even if the question in the exam gives you a period of 6 months, 4 months, 3 months, 2 months, okay, 5 months, 8 months, 9 months, 10 months, whatever is the period given in the exam, you will assume that that period is a substantial period of time, and you will capitalize the borrowing cost for that period in the to the cost of the asset. Okay, now it says that these assets are not a qualifying assets. Financial assets are not a qualifying assets. Financial assets are not a qualifying assets. Inventories that are manufactured over a short period of time are not a qualifying asset. Okay, now tell me, this laptop, is it a qualifying asset? This laptop I have purchased, but for the company, let's suppose I have purchased this laptop from Apple. Okay, now tell me, for Apple it is an inventory. For Apple it is an inventory. Now tell me, for Apple, is it a qualifying asset, this laptop? For Apple, I'm not talking about me, I'm talking about Apple. For Apple, is it a qualifying asset? I will say you no. Why? You know what? This laptop gets manufactured within fraction of minutes. They are manufactured within fraction of minutes. They are manufactured within fraction of minutes. Okay, everything works in a system. Okay, I can say that within 5 to 10 minutes, around 100 or 200 laptops gets manufactured in a batch. So now you cannot say that 1 minute is a substantial period of time. No, right? Let's forget about laptop. Even the big cars that you see, okay, the cars that you see, okay, the Mahindra, or you can say Honda City, right? All these companies, the cars that you see, okay, BMW or this, right? So these cars also get manufactured within 5 to 10 minutes. One car takes 5 to 10 minutes. That's all, nothing else. Okay, so everything is ready. They just need to assemble it up. That's all, nothing else. Okay, the assets that are already ready for use or sale when acquired. Okay, let's suppose I have taken, yes, if it takes a longer period, if it takes a substantial period of time, then yes, it is a you can say qualifying asset. Okay, and if it is a qualifying asset, then if you have incurred any borrowing cost on that, it will be capitalized to the cost of the asset over the period of whatever borrowing cost you incurred during the period of capitalization, that will be capitalized to the cost of the asset. Now, if let's suppose you have purchased an asset, which was ready for its use, let's suppose I purchased a land and I want to use the land itself, then borrowing cost incurred on the purchase of land will not be capitalized. I have purchased a land, but I don't want to use the land, I want to construct a building on that, borrowing cost incurred on that will be capitalized. Okay, is it clear everyone till here? Now let's move on to period of capitalization. What is the period of capitalization? So commencement, we have to discuss three things: commencement, suspension, and cessation. Okay, means what? I write in simple language. It means start. It means stop. Tell me, it means what? Pause. Simple. Let's keep it simple. Let's keep things simple. Now the standard says that you can start the capitalization only and only when all the three conditions are met. And what are the three conditions? It says it incurs expenditure for the asset, it incurs borrowing cost, and it undertakes activities that are necessary to prepare the asset for its intended use or sale. Now come here. You started on 1st of April, you incurred expenditure. Okay, now the construction started, but you took a loan on 1st of September. Tell me, what is the date of capitalization from the starting? What will the start date of capitalization? Tell me, what is the start date of capitalization? 1st April or 1st September? Tell me, what is the start date of capitalization? Tell me. 1st September. Now it says that the date when all the three conditions meets. Okay, it is a date which is called as date of start of capitalization date. Okay, when all the three conditions meets. Now suspension means the any period over which the active development is suspended. If the active development is suspended, then you have to stop the capitalization of borrowing cost over that period. Okay. Now cease when the substantially all the activities necessary to prepare the qualifying asset or a part of it for its intended use or sale are complete, then you will stop the capitalization. Basically, when the asset is constructed fully, you will stop the capitalization. Tell me, is it clear, everyone? Is it clear, everyone? Tell me, guys, come on. Now note, borrowing cost incurred. Read this line, I have already explained. Read this note, I have already explained this note. Read it and tell me, is it confirm, is it clear, everyone? Read this note. Clear? So it says what? Borrowing cost incurred while land is under development are capitalized during the period in which activities related to the development are being undertaken. However, borrowing cost incurred while land acquired for building purposes is held without any associated development activity do not qualify for the capitalization. Meaning thereby, if I've just acquired for the land for using the land, borrowing cost incurred will not be capitalized. But if I've acquired a land to construct a building on that, the borrowing cost incurred on the purchase of land will also be capitalized. Now, borrowing cost eligible for capitalization. Understand. The loans are of two types. The borrowing are of two types: general borrowing and specific borrowing. What is the meaning of general borrowing and specific borrowing? Standard says that if you have taken a loan specifically for the construction purposes, that is called as specific borrowing. But if you have taken a loan for general corporate purposes, like let's suppose you are using that loan for the day-to-day salary payment, day-to-day expenditure, salary of the employees, working capital requirements, okay, and you are also using that loan for construction of a property, right? It is called a general loan, a loan which is for the general purposes. It's called a general loan, a loan which is specifically taken from the bank for construction. It is called a specific loan. Now the treatment of these two loans are different. Now tell me, under general borrowing, if I incur any borrowing cost, tell me, can I identify how much of the borrowing cost is for the construction of this property? Can I identify? No. So standard says that for general borrowing, what you have to do, the company might have 2-3 general borrowings. The company might have 2 or 3 general borrowings and all the borrowings are taken at different rates. So standard says that first of all, find the average capitalization rate. What is the average capitalization rate? Weighted average borrowing cost on outstanding borrowings of the entity, excluding specific borrowings. Okay, and total outstanding borrowings of the entity during the period. Okay, let's suppose I have two borrowings, $10 million at the rate of 12% and $8 million at the rate of 10%. Okay, I have two loans. Now what is my capitalization rate in this case? So what is my borrowings? 1.2 million. What is my borrowings? My borrowings is 1.2 million and the borrowings is 0.8 million. So total borrowing is 2 million divided by what is the total borrowing? Total borrowing cost is 2 million, right? And total borrowings is 18 million. So what is the rate? 2 by 18 is how much? 11.1. So 11.11 is the average capitalization rate. Is it clear, everyone? Right now, standard says that multiply this capitalization rate with the expenditure incurred on the qualifying assets. Whatever is the expenditure incurred on the qualifying assets, multiply by also you do the time adjustment. Also you do the time adjustments, and this will give you the borrowing cost to be capitalized. Just for an example, I'll come here. Let's suppose during the year you have incurred costs here, you have incurred costs here, you have incurred costs here. This was let's suppose 1st of April, this was 1st of July, this was 1st of September, okay, 1st of August. Then okay, now let's suppose the capitalization rate is 11.11 percentage. Now what suppose you have incurred around, let's suppose 2 million here, you have incurred let's suppose you have incurred 0.8 million here, you have incurred 0.5 million here, and you have incurred 0.6 million here. So what is the borrowing cost to be capitalized? So the borrowing cost to be capitalized will be 0.8 million multiplied by 11.11 percentage multiplied by how many months? 9 by 12. Right now, this one will be 0.5 multiplied by 11.11 percentage multiplied by how many months? Tell me. 6 by 12. Now here will be 0.6 million into 11.11 percentage into how many months? 8, 9, 10, 11, 12. 5 by 12. Right. So this total will be called as borrowing cost to be capitalized. Is it clear, everyone? Is it clear, everyone? Tell me. This is how the treatment of general borrowing works. Tell me, is it clear, everyone? This is the treatment of general borrowing. Tell me, is it clear, everyone? You guys are not giving me boosters. Not at all happy with you. I'm not at all happy with you. You guys are not giving me boosters. Every time I have to ask for the boosters. Booster is the secret of my energy, guys. If you will not give me energy, how will I tell for 4 hours? You have to give me energy. Good. Now, the another form of borrowing is specific borrowings. The another form of borrowing is specific borrowing. Yes, Vasali. Hi. Hi. The Josh should be very high. This time, FR, ACCA should think like, how come these students are scoring this much marks? So you should say, we are students of Vishal sir. We will score the as good as possible, the best marks. Okay. Say to ACCA that set the difficult paper, the most difficult paper you want to. I don't fear you. Say to ACCA, I don't fear. Set the difficult paper as difficult as you can. Let's challenge. Let's challenge. Okay, now let's study about let's study about specific borrowings. Now, for specific borrowings, the logic works different. How come? Okay, the logic should work is like this borrowing I have taken for construction. The borrowing cost that I am incurring is for the construction. The total borrowing cost that I am incurring, the total borrowing cost that I am incurring should be capitalized to the cost of the asset. Okay, should be capitalized to the cost of the asset. Now, Harsh Thakur is saying memes here. See, sirf Vishal mat, don't say only Vishal, say Vishal. Okay, so let's suppose this is the period of capitalization. This is the period of capitalization. This is the period of capitalization. Okay, now what happens? I have taken borrowings here and I repaid the borrowings here. Tell me, the borrowing cost incurred here, the borrowing cost incurred here, will it be capitalized? Okay, fine. Let me tell you, let me give you this borrowing cost incurred here is called as A. The borrowing cost incurred here is called as B. The borrowing cost incurred here is called as C. Okay. Now I had some temporary funds which I invested here is called as D. Okay. Investment income is called as D. Investment income for this period is called as E. Now tell me what will go to P&L and what will be capitalized to the cost of asset. And D. A plus C as borrowing costs and D as investment income. The cost of the asset will be B minus E. Tell me, is it clear, everyone? A and D PL, C and C also P&L. B minus E will be cost of the asset. Tell me, is it clear, everyone? Is it clear, everyone? Tell me, is it clear, everyone? So meaning thereby, any borrowing cost incurred prior to the period of capitalization or any borrowing cost incurred beyond the period of capitalization, P&L. In case of specific borrowings, if I have some temporary funds, I can invest, right? I got the borrowings. I know the construction will start from here. So rather than keeping the funds in my savings account, I thought let's invest it somewhere. So I invested the funds and I earned the investment income. So this investment income will also go to P&L. Okay. So let's write this will go to P&L. This will also go to P&L. This will also go to P&L. Now this will be capitalized. This will be capitalized. Okay. This is how it will be capitalized. Is it clear, everyone? Tell me. Is it clear, everyone? Tell me. Now come here. See, for specific borrowings, actual borrowing cost incurred less investment income on the temporary investment of those borrowings. Tell me, is it clear, everyone? Now, so this is about specific borrowing. This is about general borrowings. Now, read these two notes. I've already discussed these two notes also. I've already discussed these two notes with you. Please discuss. Please read it off. So standard says that the fund, when funds are borrowed specifically for a qualifying asset and it remains outstanding after the related asset is ready for its intended use or sale, it becomes part of the general borrowing and interest cost gets recognized in P&L. I discussed it off, right? Now, when the entity has no borrowings and it uses its cash resources to finance the construction of a qualifying asset, the entity cannot assume that the interest that could have been earned on that cash represents foregone benefit, notional borrowing cost, and could be capitalized, meaning thereby notional borrowing cost will not be capitalized, okay. This statement is correct, but the way I have written is wrong. So let me change the way, and such borrowing costs could not be capitalized. Is it clear, everyone? The borrowing cost? Is it clear, everyone? The borrowing costs? These are small points, guys, but if you don't recall it properly, you will face challenges in this one. I hope it is clear to everyone till here. Wonderful. Let's start intangible assets. Is it clear, everyone, guys? So it's where to find notes. I will be sharing these notes. I'll be sharing these notes after the class. Okay. I'll make a drive. Okay, and I will upload these notes on the drive, and I will share the link of the drive with all of you. Okay, fine. I share the link of the drive. Okay, fine. Let's move to intangible assets. Now, what is the meaning of intangible assets? It means that intangible assets are the assets which does not have any physical substance. Okay, fine. Okay, fine. Now, understand, if it does not have physical substance, then I can say that all the assets which do not have physical substance, can it be said as intangible assets? Let's suppose my bank account, it does not have any physical substance. So can I say it is an intangible asset? Can I say it is an intangible asset? Tell me. No, right? So it has to be non-monetary. Okay, it has to be non-monetary. Plus it has to be identifiable. Sir, why didn't we write this word of identifiable in case of PPE? Because PPE, the asset, this laptop, I can actually identify this laptop. I can see this laptop. I can identify this laptop specifically. Now let's talk about brand. Let's talk about brand name. Is it, can you see, can you identify? No, no, no. So standard is saying that you can recognize you can say that this asset is an intangible asset only if it is identifiable, non-monetary, and does not have any physical substance. And if it doesn't have any physical substance, if all the three conditions get satisfied, it is then only I can say that it is an intangible asset. Now, what is the meaning of identifiable? It says that an asset is identifiable if it is either, just a minute, okay, if it either is separable, if it is either is separable, or arises from contractual or other legal rights, or arises from other contractual or legal rights. Now, what is the meaning of separable? What is the meaning of separable? Let's suppose I have acquired a tally license. Is it separable? Tell me. Tell me. Is separable means it can be sold, exchanged, rented, is separate from the entity. I have acquired a tally license. Tell me, can it be sold? Can it be sold? Tell me, can it be sold? Yes, it can be sold. It can be sold, right? I have taken a subscription. Okay. Basically, I have, you can say, the government has given me a license. The government has given me a license. The government has given me a license to drive bicycle. Okay. Now, can it be separated from me? Can it be separated from me? No. But don't you think it arises from legal or contractual rights? It arises from legal or it arises from legal rights? It arises from legal rights? Yes. So it is again identifiable. It says that it has to be satisfy either of them, either or. Okay. Now, so basically the example here is let's suppose patents, or you can say brand name, or you can say, let's suppose any of the intangible assets or softwares. So they are identifiable. Okay. They are identifiable if and only if they are either separable or can be or they arises from contractual or legal rights. The example of license, the license the government has given me, it is not separable. Okay, but it arises from legal or contractual rights. Okay, legal or contractual rights. Now let's suppose my YouTube channel, our YouTube channel. Okay, now this YouTube channel, is it identifiable? Tell me, is it identifiable? Yes. If I want, I can sell this YouTube channel to someone else. If I want, I can sell this channel itself to someone else. It happens in the practical world. It gets sold off. Now the customer database, you know what? In the bank, when you do the KYC, all the data is there with the bank. Okay. Now the bank has an option that they can sell this data to you can say the finance companies, right? And this data is being sold in the market. Right? So now tell me, so this customer database is also identifiable. Why? Because it can be sold. So meaning thereby I'm saying any intangible item is identifiable. Any intangible item is identifiable if it is separable or it arises from legal or contractual rights. Okay, or it arises from legal or contractual rights. Sir, what if only one condition is met? Then also it is identifiable. I have written here or. See, I have written here or. Either it should be separable or arises from legal or contractual rights. Okay. See, I have written here. See here. Regardless, if it arises from legal or contractual rights, I have written here. See, regardless of whether those rights are transferable or separable. Meaning thereby, if it arises from legal or contractual rights, even if it is not separable, still it is identifiable. Still it is called as identifiable. Now, recognition principle is same as property, plant and equipment, meaning thereby probable that the future economic benefits will flow to the entity and the cost can be measured reliably. So recognition principle is done. Measurement principle, initial measurement same as property, plant and equipment. Subsequent measurement, both cost model or revaluation model also same as property, plant and equipment. I am not discussing it again. Is that clear? Now, so it is same, but one point is there that I have to discuss. Meaning of directly attributable cost again is same. Subsequent cost treatment is again is same. Measurement principle again is same. Entity has to choose cost model or revaluation model as its accounting policy shall apply to all class assets in the same class. Okay, again intangible assets can be of different classes. Intangible assets can have different classes. Okay, see again it is same. Now subsequent measure revaluation model, scope of revaluation model. Now this is the difference point. This is an important point I am highlighting here, important. What it says, revaluation model can be applied only if active market exists for that intangible asset. An active market is a market when the asset is sold in sufficient volume and frequency. Now tell me one example of property, plant and equipment, and one example of intangible asset. So now one example of property, plant and equipment can be a machinery. Tell me, if on any particular date you want to find what is the market price of this machinery or what is the fair value of the machinery, can you find it out? Tell me. If you want to find what is the fair value of the machinery, can you find it out? Yes, you can find. You can just go and check in the market what is the price of this, what is the price of this machinery, right? You can go and check in the market, right? For this machinery, what is the price that I can get? You can definitely identify. But for a brand name, let's suppose Zomato has a brand name. Tell me, can you go in the market and check what is the fair value of the brand name? Now someone will say that, sir, yes, I can appoint a valuer and he can do the valuation of the brand name. Yes, they can do, but that can be manipulated. Right? So is it sold in the active market? Active market means it is sold in sufficient volume and frequency. Let's suppose if I have to find what is the fair value of this phone, I can find, because I know I can go and check the price in the Amazon. Right? I can find the fair value of it. But if I have to find what is my goodwill in the market, if I have to find what is the value of Vishal Jain in the market, can I go and check it? Is there any place where the goodwill of Vishal Jain is being purchased or sold? No, I cannot find it off. Right? So that's the reason why it says that intangible assets we can apply fair value model to intangible assets if and only if it has active market. Otherwise, no. Is it clear, everyone? Now frequency again is the same as PP. Treatment of revaluation gain or loss is same as PP. Revaluation approach is same as PP. Treatment of revaluation is same as PP. Amortization is same as PP. Just the name changes from depreciation to amortization. It is same as PP. Okay, now here comes the different important point. First of all, clarify if it is clear to everyone till here. First of all, give me confidence that it is clear to everyone till here. See, we are already completing intangible assets. Only this much is remaining intangible assets, right? So we had a target of completing 5 standards today, out of which after completing intangible assets, we will be done with the 4 standards. 1 standard will be left, that is impairment of assets. Tell me, guys, is it clear everyone till here? Is it clear to everyone till here? Everything, is it clear? Okay. Modes of acquisition of an intangible asset. What if I have internally generated intangible assets? Now example is, let's suppose Zomato wants to get its application developed. Okay, Zomato wants to get its application developed. Now you know what, Zomato has two options. Zomato will ask one consultant, one expert who develops the application to develop an app for you. Okay, let's suppose for my Vishal Jain classes, let's suppose I appointed an expert who developed an app for Vishal Jain classes. Okay, now but Zomato knew that this is a very, see, in our classes the frequency is not so high, right? Once the student gets registered, he is there for the 3 months, right? But in Zomato, what happens? The frequency is quite very high. So the maintenance that is required is quite very high. Right? So what happens in this case is, they need a team who can maintain the application also. So what happens generally in these case of like Zomato, Swiggy, like all these startup companies, like Uber, Ola, all these companies, they have the in-house IT team. They have the in-house IT team, and the IT team develops the application and maintains the application. Okay, so they get it self-developed, they get it internally generated. Okay, now what should be the how do we capitalize the internally generated? So now understand, whenever we internally generate any intangible asset, there are two phases. Now tell me now one thing. Okay, whenever you talk about innovation in any industry, you talk about a department. What is the name of the department called as? Tell me. Whenever we talk about innovation in any company, we talk about what department? R&D department. Tell me yes or no. We talk about R&D department, research and development team. Tell me yes or no. Why research and development team? Because what is the meaning of innovation? First of all, we research on the idea. And assess it is feasible or not. Once we assess, yes, it is feasible, then we start to develop the asset. The standard says that the cost that is being incurred on the research, will be incurred irrespective of the fact whether you develop the asset or you don't develop the asset. Right? So the cost which is incurred in the research phase, the phase where the original or the planned investigation for gaining knowledge, this cost, the cost incurred in the research phase will be transferred to P and L. But the cost which you incur in the development phase will be capitalized to the cost of the asset, capitalized to the cost of the intangible asset. Okay. Now question comes up, sir, tell me now, how will I identify that this phase has changed from research phase to development phase? How will I identify that the project is in the research phase or development phase? So the date when all these conditions, get satisfied, I can say that that this project is in the development phase. What are the conditions? Probable economic benefits will be there. I have intention to complete, I have resources to complete, I have ability to complete. Meaning thereby, I want to complete whatever resources is required to complete this project. I have all the resources and I have the ability to complete. See, understand. I want to purchase BMW car, but can I go and purchase it now? I don't have the ability. So if I can purchase BMW car or not, so for that I will assess two things. Whether is my willingness, willingness is there. I want to, but is my ability there? No, I don't have the ability now. Right? So you have to see the ability and the willingness both. Okay. Now, intention to complete, resources to complete, and the ability to complete. Okay, technical feasibility should be there, meaning thereby if we go ahead in this project, we will be able to technically complete the project and the expenditure can be measured reliably. If all these conditions get satisfied, then yes, this project in the development phase. Now let me discuss with you one more point. There are three phases, not two. One is research phase. One is development phase. And one is developed phase. Now, all the expenditure incurred in the research phase will be transferred to P&L. All the expenditure incurred in the development phase will be capitalized. But will we amortize it? Tell me, will we amortize it? No. Once I enter the development phase, I will start to amortize it. Is it clear, everyone? Tell me yes or no. Yes. And till the time it is under development phase, since it is not amortized, we will do annual impairment review. We'll do annual impairment review. Very good, Vaishali. Though I had to discuss this point as part of impairment, but fine, you have raised very good point. Annual impairment review. We have to do annual impairment review. Very good, very good. Is it clear, everyone, till here? Come on, guys, tell me. Is it clear, everyone, till here? Now, with this, I complete my internally generated intangible assets. Now, self-generated. Now, there are some assets which gets developed on its own. We have not taken any specific efforts to develop it, like brand name, like goodwill, right? Like customer lists, right? So these intangible assets gets developed on its own. Okay. Now tell me, can we recognize it in the financial statements? Can we recognize that in the financial statements? Can we recognize it in the financial statements? Can we recognize this in the financial statements? No, we cannot recognize. No, we cannot recognize in the financial. Why? Because the cost cannot be measured reliably. Because the cost cannot be measured reliably. Okay, because the cost. But now tell me one thing. Let's suppose Tata acquires Zomato. Okay, Zomato had customer lists which Zomato was unable to recognize. Why? Because it was internally generated and the cost was not measurable. Now Tata acquired Zomato. In case of business combination, Tata acquired Zomato. Now tell me, in the consolidated financial statements of Tata, can I recognize this customer list? Yes, we have to recognize. Customer list will be recognized. Why? Because Zomato the founder of Zomato knows that this customer list has a price. So when Zomato is selling the entity to Tata, Zomato will charge for the customer list. Means Tata has paid a price for this customer list also, and hence this price has to be recognized. This customer list has to be recognized. Can be recognized. Okay. Is it clear, everyone? Tell me, guys. Come on. Is it clear, everyone? Umang Ojha is there. He is my friend. You see, he is commenting. Okay. Now, amortization of intangible assets. It is systematic allocation of amortizable amount as for its useful life. So basically, all these the concepts remain the same as the property, plant, and equipment. The concept remain the same as property, plant, and equipment. So I'm not explaining it again. Okay. Now moving to intangible assets with indefinite useful life. The concept now intangible assets with indefinite useful life. Okay. Now understand. Let's suppose I have acquired a intangible asset, example being a license, a tally software license, and the license is for, let's suppose, 5 years. Okay, I have paid the amount. So now that is an intangible asset with finite life, 5 years. That is an intangible asset with finite life, 5 years. Okay, so I will amortize it over the 5 years. But now let's suppose I have an intangible asset which does not have any life. Like, let's for example, brand name, it doesn't have any life. Okay, now what will we do for that? Will we amortize it? No, I will do the annual impairment review. So for all intangible assets with indefinite life or infinite life, okay, we will not amortize the asset, rather we will do the impairment testing. Annually. Now, sir, you will ask me, then what's the difference here, sir? Let me tell you. When you will go to IAS 36, I will tell you impairment standard. I will tell you that impairment test has to be done only and only when there is an impairment indicator. Only and only when there is an impairment indicator. Okay. Otherwise, impairment test is not required to be done. But here for these assets, since I am not amortizing this asset, hence I have to impair it annually. Hence I have to test it for impairment annually. Now when I am testing the asset for impairment, does it mean that the asset will necessarily be impaired only? No. It can be impaired, it cannot be impaired. Okay. But I have to do the impairment review every year for this asset. Is that clear, everyone? Now, so far I have discussed two things for impairment. That is the intangible assets under development phase and intangible assets under with infinite life. For these two assets, I will do annual impairment review. Is that clear, everyone? Is that clear, everyone? Now, cannot be amortized, rather these intangible assets has to be tested for impairment annually at the same time every year. Derecognition is the same as a PPE, right? See, what can I say for rest for this? I have just done the copy paste here. See, the name is also I forgot to change. This is the testimony to the fact that it is same. Okay, mistakes, sorry, it is intangible asset. Okay. Now, tips from the examining team: intangible assets acquired in a business combination is recognized at fair value on the date of acquisition. Clear, everyone? Clear, everyone? Mistakes can happen from me also, right? Now, moving on to the last standard for the day, impairment of assets. Clear, everyone, so far? Wonderful. Now, what is the meaning of impairment? Okay. See, we studied, right, that for an asset, it should have future economic benefits, right? How's the Joes? High. How's the Joes? High. Now, so we studied for a non-current asset, basically that the recognition principle. In the recognition principle, we studied that the asset can be recognized in the books of account only and only if it has future economic benefits, right? We can recognize the asset in the book financial statements if and only if there is a future economic benefits for that asset. Okay, now understand. So basically what happens here is, on the date of initial recognition, IAS 16 property, plant and equipment standard is checking. Okay, now see here. I will tell you what exactly is the relevance of IAS 36. I will tell you. Have you ever went to any concert or any live shows? Ever been to any concert or live shows? Now, okay, fine. I will tell you what happens there. On the gate, let's suppose this is an entry gate. Okay. Now there will be a security guard standing, right? Who will check if you have ticket or not. If you have checked ticket, then entry. No ticket, then go out, then go home, right? If no ticket, then go home, okay? Now, right? Now, so this security guard is property, plant and equipment. This security guard is property, plant and equipment, or it is, you can say, investment property, or it is intangible asset. Okay, this is security guard, the name of this is. Now once you enter, inside also there will be some security guards. Inside also there will be some security guard, right? Now these security guard, if they find oh, this person might not have ticket, if they have suspicion on any specific person, they go and ask, please show me your ticket, right? Happens? Tell me yes or no, happens or not? Tell me yes or no, happens or not? But this security guard will check for each and every one. But this security guard will check only if there is a suspicion. Tell me yes or no? Same thing. This is 36. This is 36 standard, IAS 36. This is IAS 36, right? So now PPE, IP and IA, they will not allow the asset to be recognized if they don't have future economic benefits, right? If they don't have future economic benefits. Now IAS 36 just checks if there is suspicion, if there are impairment indicators, they will ask the person, show me your ticket. Now if they have asked the person to show their ticket, does it mean that the person doesn't have the ticket? No, they can have the ticket, they cannot have the ticket, right? It can be the case, right? Tell me yes or no. Now Dakshish Gandhi is telling the real life situations. Yes, it happens. Okay. Now, so this is what happens. So 36 comes into the picture in the subsequent phase. Okay. Now, once the asset is already recognized, we just see if there are impairment indicator getting triggered. Okay, impairment indicator getting triggered. If it gets triggered, then only IAS 36 will check for impairment. Otherwise, no. So I believe this example would have helped you guys in understanding the difference between the recognition principle of 16, 38, 40 versus 36. Okay. Now, so it says that if you believe that the asset is not fully recoverable subsequently, then you have to check the asset for impairment. How will you check the asset for impairment? You will compare the carrying amount with the recoverable amount. If the carrying amount is this and the recoverable amount is this is the recoverable amount. Nothing to be done. If the carrying amount is this and recoverable amount is this, nothing to be done. If the carrying amount is this and recoverable amount is this, means the asset is not fully recoverable. Then what we do? We reduce the value of the carrying amount. And this amount of reduction in the carrying amount of the asset is called as impairment loss. Is it clear, everyone? Tell me. Is called as impairment loss. Is it clear, everyone? Tell me. Now, this standard on impairment is not applicable to the inventory. Why? Because inventory has its own standard for impairment, that is cost versus net realizable value. It is not applicable on IFRS 15 contract assets, right? It is not applicable on deferred tax asset. It is not applicable on biological assets. It is not applicable on non-current assets held for sale, right? It is not applicable on financial assets. So it says on these assets it is not applicable. On these assets it is not applicable. Now timing of impairment. See here. What it says: an asset needs to be tested for impairment when the impairment indicators are triggered. When the security guard has a doubt on someone, then only they will go and ask for the ticket. Otherwise, no. Okay. Now, a specific rule is we have to do the annual impairment testing at the same time every year for these three assets. And what are three assets? Intangible assets with indefinite life. Okay. Intangible assets under development, that is not available for use as of now. They are under development. Okay. Now, goodwill acquired in a business combination. Tell me, goodwill has a life? Do you think goodwill has a finite life? No. Goodwill also doesn't have finite life, right? So it says that goodwill also needs to be tested for impairment annually every year. Okay. Goodwill is not amortized, rather they are tested for impairment every year. Now, I am writing the logic here. Can you please read it? Why such treatment for these three assets? Why such treatment? It says that as per IAS 38, since these three assets are not amortized, hence they needs to be tested for impairment annually at the same time every year, and whenever there are impairment indicator gets triggered. What is the meaning of this line? Let's suppose I have a goodwill, okay, which I test for impairment in the month of February. So every year in the month of February, I will test it for impairment. Every year in the month of February, I will test it for impairment. Every year in the month of February, I will test it for impairment. Okay. Now, further it says that, let's suppose on this date, there is an impairment indicator. There is an impairment indicator that this goodwill is further impaired, right? Now it says additionally, you have to test the goodwill for impairment here also. You have to test the goodwill for impairment here also. Okay. This is mandatory, but this has to be done only when there is an impairment indicator, right? This has to be done only for this approach has to be followed for only three assets, And what are those three assets? Those three assets are goodwill and intangible assets with infinite life and intangible assets under development phase. Okay. Under development phase. Okay. Now, for all the remaining assets on which IAS 36 is applicable, on which impairment standard is applicable, I will test it for impairment only when there is an impairment indicator getting triggered. Now you must ask me, sir, what is the meaning of impairment indicator? So impairment indicator can be, this is not applicable for you guys. Sorry, this is not applicable for you guys. This is from an SBR perspective. Okay. When I was making the notes, I was making notes for the FR and SBR together. Okay. So from an SBR perspective, I forgot to ignore it off. So you can ignore it off. You can ignore that off. Okay. Now impairment indicator can be internal indicator, can be external indicator. Now, what are internal indicators? Physical damage to the asset, significant changes in the use of the asset, worse economic performance. Now, what are external indicators? Significant decline in the market value, significant change in the technology. Now, let's suppose now AI is coming, artificial intelligence is coming, right? So many of the assets will become redundant, a new asset will become, right? So that's what. So when the new technology comes up, the price of the old technology reduces. Right? Increase in the market interest rate, and the carrying amount of the net assets of the entity is more than its capitalization, market capitalization. Okay. So these are impairment indicators. Is it clear, everyone? Till here? Come on, guys, tell me, is it clear, everyone, till here? Anyone having any queries so far? If there is any query, please discuss that with me. Otherwise, I'll move ahead in the class. Is this session helpful, guys? Session was helpful? Now, plans to sell an asset. Okay, that concept is not here, Krishna. We'll discuss that standard of that concept, but in SBR level, not at FR level. Okay. Now, an entity can recoverable amount. Now tell me, let's suppose I have this phone. Tell me, how can I recover the value of this asset? Either by using the asset or by selling the asset. Tell me yes or no. How can I recover the value of this phone? Either by using this phone or by selling this phone, right? Right now. So recoverable amount means, let's suppose if I have this phone, I'm talking in INR terms, just for the example here. Okay. Let's suppose I have this phone. Okay. Now what happens is, if I use this phone, I know that I will get a value of rupees 4,000. Okay. And if I sell this phone, I will get a value of rupees 5,000. Tell me, what should I do? Use or sell? If I use, I will get a benefit of 4,000 rupees. If I sell, I will get a benefit of 5,000 rupees. Tell me. Sell, right? So a rational person will definitely take the higher one, take the higher value, right? So same thing is happening here. Recoverable amount can be value if sold, that is fair value less cost of disposal, value if used, that is value in use. Whatever is higher is your recoverable amount. Whatever is higher is your recoverable amount. The calculation of fair value less cost of disposal and value in use is not in your syllabus. The question will give you the calculated value. So calculation is not in your syllabus. You will study the calculation of these two at SBR level. At FR level, the calculation is not needed. They will give you the calculated values. Okay. Now, but yes, you have to keep in mind few things. In the exam, if question gives you fair value, then ignore transportation cost as it is already adjusted in the arriving at fair value. Okay. Because fair value, what is the meaning of fair value? What is the meaning of fair value? Meaning of fair value is market price minus transaction costs. Not transaction, sorry, transportation costs. Sorry, transportation costs. Transportation costs. Market price minus transportation costs, right? Now, so it says that if the question gives you fair value and the question gives you transportation cost both, then ignore transportation cost. Forget, ignore it off. Okay. Now, if the question in arriving at cost of disposal, do not consider financing cost and tax costs. Okay. Now, recognition and measurement of impairment loss. Okay. Recognition and measurement of impairment loss. Understand. See, once you know what is the carrying amount, now tell me, how will you determine the carrying amount? Carrying amount, you have to find as per the respective standard, 16, 38, 40, right? As per the respective standard, you have to find the carrying amount of the asset. Recoverable amount we discussed, right? Now, if the recoverable amount, let me write here. If the recoverable amount is higher than carrying amount, what will we do? Nothing, no treatment. Meaning thereby my asset is fully recoverable. If the recoverable amount is equals to carrying amount, what will we do? Again, no treatment. If the recoverable amount is less than carrying amount, recoverable amount is less than carrying amount means the asset is not fully recoverable. Okay, then the difference carrying amount minus recoverable amount is equals to impairment loss. Now, what will be the treatment of impairment loss? Standard says that if the asset is under cost model, you will transfer this impairment loss to P and L. But if the asset is under revaluation model, then what will you do? You will adjust this impairment loss with the revaluation reserve. And this is where I was asking you to be careful. You remember I told that revaluation reserve can be treated in two manners. One, you can transfer it at the time of derecognition, transfer to RE at the time of derecognition, or another is revaluation reserve. You have to transfer to RE every year over the remaining useful life. Now, once you are transferring the revaluation reserve to RE over the remaining useful life, and you have an impairment loss in between, which you have to adjust with the revaluation reserve. So be careful in finding that what exactly is the balance of the revaluation reserve after transferring to the retained earnings, and then adjust the impairment loss with the carrying amount of the revaluation reserve. Are you understanding this point? Come on guys, tell me. This is a very important point and I have seen students making mistake in this point. Tell me, is it clear everyone? Subsequent to impairment, revised carrying amount of the asset will be depreciated over the remaining useful life, may be reassessed on the impairment of the asset. Okay, basically it says that after impairment you will depreciate the asset, depreciate the remaining carrying amount over the remaining useful life. Now it might be the case that the remaining useful life might change. Okay, I'll give an example of it. Let's suppose you purchase the asset for 1000, the life is 5 years. The life was 5 years. Now, at year end 2, what is the carrying amount? 600, right? Now, the recoverable amount is, let's suppose, 450. The recoverable amount is, let's suppose, 450. So, what is your impairment loss? 150. Where will this go? It will go to P&L. Tell me yes or no. Now, what is the depreciation for this year? Now, the revised carrying amount is 450 and the remaining useful life is 3 years. Remaining useful life is 3 years. But I say that no, the asset is damaged now. The asset might not function for 3 years. The asset will function only for 2 years. So, what is the depreciation per year? What is the depreciation per year? It is 450 by 2, that is 225 per year. For this year and this year, there is no like this year. Is it clear, everyone? Not 150, Dakshesh, it is 225. Why? Because I have changed the remaining useful life from 3 years to 2 years. That I have reassessed. Moving back to the concepts. Recognition and impairment and measurement of impairment loss. Understand? See, there are times. Let's suppose. Tell me one thing. I have a laptop. Tell me, do you think this laptop will be able to generate cash flows independently? No. The laptop needs the support of the camera. It needs the support of the desktop. It needs the support of the writing pad, the pencil, the mic, right? The mic, all of the rest, all connecting equipments, right? Connecting equipments, everything, lot of things are there, right? And me also, right? And me also, if all the equipments are there but I am not there, will you give the fees? No, you will not give the fees, right? So basically, everything cumulatively generates me cash flows in the nature of fees. Individually, laptop has no value. Individually, monitor has no value, right? So, so internet also, right? Everything, but internet is not an asset. Again, that says I remember that this is the same thing you mentioned in the live class also. Milan, I will share it off. No, I will set it off. Please do not spam the chat box. Okay, now, so there are assets which are not able to generate cash flows independently. But let's suppose there is a public transport bus. Is it able to generate cash flows independently? Tell me. Public transport bus. Can public transport bus generate cash flows independently? Yes, they can. Okay. Now further. Okay, it says that if the asset is not able to generate independent cash flows, we have to check, is the asset capable of generating independent cash flows? Yes. Then what will I do? I will check the impairment indicator exists or not. I will check whether the impairment indicator exists or not. Okay, if impairment indicator exists, then test the asset for impairment. That is, compare carrying amount versus recoverable amount. If the impairment indicator does not exist, then no treatment. Fine. The public transport bus has, understand, public transport bus, they can generate cash flows independently, right? They can make the passengers sit in the bus, they will generate the fare, right? So the public transport bus can generate the cash flows independently, but this laptop cannot generate the cash flows independently, right? It needs the support of lot of other equipments. Okay, now it says that if the asset is not able to generate cash flows independently, then identify the cash generating unit. Identifying the cash generating unit to which the asset belongs. Identify the cash generating unit to which the asset belongs. What is the meaning of cash generating unit? Cash generating unit is the smallest identifiable group of assets capable of generating independent cash flows. Okay, now what is the meaning of smallest possible? What is the meaning of smallest? Let's suppose, though in this studio room there are lot of equipments. Okay, lot of equipments. Some equipments are stored as a spare part also in this cupboard. Lot of equipments are stored as a in the other, you can say this one, spare parts. In the last batch itself, I faced an issue with the laptop also. So I have stored a laptop also as a spare. Okay, so that if there is any challenge with this laptop, I can compare with this one. Okay, so I can have one extra spare laptop. Okay, I have everything spare, everything as a spare. Now tell me one thing. Are all the assets required to generate cash flows? No. No. Laptop, monitor, connecting equipments, mic, camera, writing pad, pencil. They can generate cash flows. There are a lot of other equipments also, lighting equipments, a lot of other equipments are there, okay? They are, even if they are not there, I can generate cash flows. Right? So I have to see smallest possible. See, I have to see like this. See my fingers, all of you, come on. See my fingers. I have to see this asset. Are you capable of generating cash flows? If it says yes, okay, fine, I will test you for impairment. If there are impairment indicator, I will test you for impairment, okay, fine. Now, but he says, now again I'm asking him, are you capable of generating in cash flows? He says no. He says no. He says no. Now once he says no, then he says I need the help of this asset. So okay, fine. You both, will you generate independent cash flows? He says no, I need the help of this also. So let's come here. Can you three generate independent cash flows? Yes, we three can generate independent cash flows. Now these three will become a cash generating unit. We have to identify the smallest identifiable group of assets. Okay, sir, why smallest? Again, this was one of the reasons why smallest. Another reason for why smallest is the smallest is the group. The smaller is the group, the more accurate is the amount of impairment loss. The smaller is the group, the more accurate you will get the amount of impairment loss. Okay, the more accurate you will get the amount of impairment loss. Is it clear? The smaller is the batch size, the more personal attention we can give to the students. The higher is the batch size, the less personal attention we give to the students, right? So that's why similar way, the smaller is the group, okay, the more accurate impairment loss we will get. Is it clear everyone till here? Now tell me. Now once you identify the CGU, check whether the CGU is impairment, whether there is an impairment indicators for the CGU. If the answer is yes, then test the CGU for impairment. If there are no impairment indicator for the CGU, then no impairment, then no treatment. Okay, now once you find the impairment loss for the CGU, then how should you treat it? So this is how you should account for the impairment loss of CGU. First of all, you should allocate the impairment loss to specifically pre-impaired asset, then impair goodwill, and then the remaining impairment loss you will allocate to the remaining applicable assets in the ratio of their carrying amount. Okay. Now reversal of impairment loss. This point I will explain with the help of example. I have the question on this one. Now see, this is the question. This question I have taken from where? BPP practice kit and revision kit. Okay, come on, let's start to solve this question. So what is said? This is a CGU. This is the carrying amount of CGU. So let's write here. This is the carrying amount of CGU is how much? 1010. Now what is the recoverable amount? See, the recoverable amount of the CGU is 750,000. So right, recoverable amount is 750,000. Now what is the total impairment loss? What is the impairment loss? Tell me. 1010 minus 750 is 260. Now what does it say? Following an impairment review, it was discovered that an item of plant carried at 40,000 is damaged and will have to be scrapped. So this is a pre-impaired asset. So what I will do, first of all, I will allocate it to plant. How much? 40,000. Then I will allocate this impairment loss to goodwill. How much? 90. Tell me what is the amount of impairment loss remaining? 130. Now current assets, will I impair the current assets? Tell me, will I impair current assets? No, I will not impair current assets. Now when it comes to identifying the CGU, if CGU has current asset, I do not have any option other than to include, because I have to impair the CGU, but I will not impair current asset. This, though it is a part of CGU, I will assume that it is already impaired by IAS 2. It is already impaired under IAS 2. Why? IAS 2 has a formula of cost versus NRV, whichever is lower, right? What is NRV? NRV is nothing but the recoverable amount, right? Now goodwill we have completely impaired. Now building we have not impaired. Plant was 200. Now it is divided into two parts. 40 we have impaired and 160 we have not impaired. Now understand guys, see what the question was mentioning, that an item of plant of 40,000 is damaged and will have to be scrapped, means 40,000 is, for the 40,000 it is recoverable amount is 0. For 40,000 the recoverable amount is 0, so I impaired fully this one. But in the exam a question can come up, the fair value of the plant and equipment is, let's suppose 180,000. Then in that case the impairment loss will be 20 for this one, and you will have to allocate the remaining impairment loss only to the building in that case. Okay, so you have to be very careful when you are reading the question. Okay, now the remaining impairment loss is 130, which you will allocate to plant and building. Now tell me what is the carrying amount. It is 160 the carrying amount, and building the carrying amount is 700, right? So what is the question asking for? What is the carrying amount of building after impairment loss has been recognized? Carrying amount of building. So now tell me what is the impairment loss of building. Impairment loss on building, it will be 130 the total impairment loss which I have to allocate. Now 700 is the carrying amount of building, total carrying amount is 860. So what is the amount of impairment loss? 130 into 700 divided by 860 is 106. So 700 minus 106 is how much? 700 minus 106 is how much? 594. So this is 594 is the answer. Clear everyone? Now coming back to the topic. Now reversal of impairment loss. For this I will explain this with the help of this diagram. Let's suppose there is an asset. Just give me a minute. There is an asset whose life is 5 years and the cost of which is 100. Okay, now the cost is 100. So now life 5 years. So let me draw 5 years: 1 year, 2 year, 3 year, 4 year, 5 year. Okay, fine. Now how will the asset depreciate? 100, 80, 60, 40, 20 and 0. This is how the asset will depreciate. Tell me yes or no. Right now, at year end 1, what is the carrying amount? 80. Now here the fair value, let's suppose, is 60. The fair value is 60. So you will recognize impairment loss of how much? 20. Tell me yes or no. You will recognize an impairment loss of 20. Confirm? Is it clear everyone till here? Yes or no? Now what will happen? The diagram will change now. So the diagram will become like this. Tell me yes or no. Right now, again at the end of third year, here, tell me what is the carrying amount. At the end of third year? Tell me what is the carrying amount. Third year is here, right? Tell me what is the carrying amount at the end of third year. Come on guys, what is the carrying amount at the end of third year? 30, right? 60 was the revised carrying amount, right? So at the end of first year, the revised carrying amount was 60, right? So now for it is depreciated on the basis of 15, right? 2 years. Sorry. This is how I'll interpret 60, 45 and then 30 is the carrying amount. 30 is the carrying amount, right? 30 is the carrying amount. right? Very good. Matthew, it's not Matthew. Pooja, Hers, it's not 40, it's 30. It's 40. Sorry, it's 30, it's 30, right? 30. It would have been 40 if the asset was not impaired. Since the asset was impaired and the fair value was 60, so revised carrying amount is 60, right? If the asset would not have been impaired, it would have been 40. Okay, now here on this date, the impairment indicator due to which you impaired the asset reversed, right? So you have to reverse the impairment loss also. Now, but the recoverable amount, your recoverable amount on this date, is 48. Is 48. And the carrying amount, if the asset would not have been impaired, was carrying amount if there was no impairment originally. Carrying amount if no impairment originally, if no impairment, then 40. Now tell me, when I say reverse means what? Going back to pavilion. Reverse means what? Going back to existing position. Reverse means what? Reverse means reversing what you created. Now when I say reversing what you created, you will students say, sir, we created impairment loss of 20, so I can reverse the impairment loss to the extent of 20. No, my friend, no. You have to see that if the asset was not impaired, what would have been the carrying amount? That was 40. Meaning thereby you can reverse the impairment loss, but only to the extent of 40, not beyond that. If you want to increase the value of the asset beyond 40, you can do that, but under 16 or 40 or 38. Applying revaluation model. Okay, but reversal will not allow. This is not reversal. Reversal only to the extent of this one. Is it clear? Now let's suppose now the recoverable amount is 35. What is the reversal of impairment loss? The recoverable amount is 35 here. If the recoverable amount is 35 here, tell me what is the impairment, what is the reversal of impairment loss in that case? If the recoverable amount is 35 here, then what is the reversal of impairment loss? 5. The reversal will be 5, right? The max reversal can be 10. Right? So this is what the standard says here. See, the impairment loss recognized previously, except for goodwill, I will explain the meaning of it, can be reversed if there is a reversal of impairment indicator due to which the asset was impaired previously. The reversal of impairment loss is restricted to the lower of following: recoverable amount, or the carrying amount of the asset had there been no impairment earlier. Now, what is the recoverable amount? If the recoverable amount is 48 and carrying amount is 40, then you can reverse the impairment loss only to the extent of 40. If the recoverable amount is 35 and the carrying amount is 40, then you can reverse the impairment loss only to the extent of 35. Is it clear, everyone? Now it says that impairment loss cannot, this line you can ignore it off, not required again, is for SBR. Okay, now it says that impairment loss on goodwill cannot be reversed. Goodwill once impaired is impaired for life. Is it clear, everyone? Tell me, guys. Come on, tell me, is it clear, everyone? Wonderful. Now, guys, I have discussed everything with you, each and every small points, everything I have discussed. Now, these important questions, I have to take the help of a question number 6, which I have discussed. Now, there are 5 more questions. 1, 2, 3, 4, and 5. This I have identified. Now, so what you can do, you can solve these questions on your own. Okay. And if you think, because I don't have sufficient time to discuss these questions, if you think you have any queries, you can discuss those queries with me for these questions. Okay. See, I have written the source also. This question is from the illustration I have drafted. Okay. Now, this is from the Kaplan. Okay. This is from the ACCA Study Hub. This is also from the ACCA Study Hub. Okay. The questions are easy, but yes, it is good. They are good questions. Okay. They are important questions which I have highlighted. Is it clear, everyone? I will share this file with you guys. Will you solve these questions? Will you solve these questions? Okay. If you have any queries, do reach out to me. Is that clear, everyone? Tell me, guys. Come on. Okay, fine. Done. That's all for the day. Tomorrow again we are meeting at 5 p.m. Okay. So let's meet at 5 p.m. tomorrow and we will revise tomorrow again. Okay. So that's all for the day. That's all for the day. One request I'll have. Once this live session gets over, once this live session gets over, I will sincerely request to leave comments in this. Comment in the chat box. Okay. What is your feedback? What was your feedback? Please comment in the chat box. Not in the live chat. In the chat box, you please comment it off. Okay. That's a request from my end. What exactly you mean? Provide answers. Okay, fine. What I'll do, I will provide the answers for these. Okay. Done. I hope this session helped you guys. Thanks. Bye bye.